Karan, have you started recording?
Hi, everyone. Welcome to the 2023 Wharton Fintech Conference. We are Sonal,
Sarjanal
and Shubhi,
co-chairs of this year's conference. We are thrilled to be welcoming you to the third edition of this event. Arguably, the climate now is very different from when this conference started 2 years ago in 2021. Yet our promise remains the same. We hope that today's event provides you with the fundamentals of the fintech and blockchain industry and show you why and where the financial services industry is still ripe for innovation. And to do so, we've put together a dream lineup of panelists who are investing, operating, and working in the trenches all over the US and the world. Our panels today will stream along two tracks, fintech and blockchain. To access each of these, you can go to the Stream tab umbrella and choose your preferred track from the drop-down menu. This drop-down menu also includes options for our fireside chats. And now, without taking up further time, we'll begin with the conference in about 10 minutes with the first panel of the day, Fintech in Emerging Markets. See you soon. Venkatesh.
Hi, Sonal, how are you?
I'm good. We'll
Any
begin with the panel in a little bit.
or any other last minute emergencies you've had?
No, none. Hopefully none. No more.
Oh. If I were to type something in the chat, who can see it? Can't hear you.
Sorry, yeah, it'll just be the people in the on the Zoom. So the way this is working is this is currently live streaming to YouTube, which is live streaming to Brella, which is the platform we are using to host the conference.
Super high tech. Okay. My time was all about good old fashioned in person stuff. So
We had an input. Oh my God, Benji is joining us. I'm so excited.
okay, wow, saving grace.
Yes. Okay. Benjamin, how are you?
You're muted.
Hey, can you hear me?
Yes.
Okay, amazing. How bad's my internet?
It's pretty good, I'd say.
Yeah, are you sure? Okay, cool. I can try to switch and try to get something else. I'm at an airport right now. But yeah.
Thank you so much. No, I think it works. And if we hear that anything is off, I will like DM you on Zoom.
Cool.
As a veteran of about 15 licenses myself in Asia Pacific, I completely hear you. Was it a good meeting with your regulator, Benji?
It was more about like making sure we're actually following policies and so on. It could have been a phone call, but like, you're in town, come tomorrow. I was like, fine. Sure.
Yeah, you can't say no. And so, but you were in Dar es Salaam now, or
Yeah, I'm in Dar es Salaam now. Where are you dialing it from?
Singapore?
Okay, cool. Oh, it's late there, right? Like 7, 8 p.m.
It's almost 8 o'clock, yeah. But I
Cool.
spent some time living in Rwanda, so Africa is pretty close to my heart.
Oh, nice. Super cool. By the way, you guys can hear me fine, right? Just tell me, because I don't want to be that person on the call.
No,
Yeah.
I think it's fine. And we have a few members of our team who are on the events platform. And if anyone hears otherwise, I will let you all know.
Cool. So how's business school?
It's very good. I think it's not hit me up until now that I am graduating. Last day of classes is actually in less than 3 weeks now. And up until now is just like all about the conference. And now that's sort of, after today, it'll be done. I can reflect on the beginning of the end. And it's very bittersweet. But it's been phenomenal. Yeah.
Nice.
I'm almost
Nice.
jealous.
Well,
of
it's good to
business
hear.
school.
Yeah, I'm jealous of the incoming class. But it takes a while to like get into a position where you guys have been through it, where you get into it and then you're in it and then suddenly it's over. Then you're like, what just happened?
Just give me 1 second. I'm just messaging my team about something. I can't multitask, so yeah.
Totally, no worries.
Hi. You made it.
Hey, long time no see.
I know.
I know.
Glad you can make it.
Yeah. Yeah, I'd rather like over like communicating, so there's a small chance I might not versus like not showing up at all, because I know it takes a lot of work for the team to plan these things.
Yeah. Well, I hope everything went well with the meeting.
Yeah, it did. I'm actually now in the airport, about to go on board right after this flight. I mean, at this call.
So Hannah is going to join very shortly, and she will introduce everyone in the panel, and I will go off camera and we'll hand it over to Hannah in a few seconds.
Sounds good. Hi, Sonal. How are you?
I'm good. So nice to see you.
Yeah, nice to see you too. Congrats. I didn't know you had started at Wharton.
Yeah, I'm started and now ready to graduate in less than 2 months.
Okay. Really? Last year is a blur.
Yes.
That's great.
Hi everyone, looks like we're good to start. Hi everyone, thanks again for being here today. I'm Hannah Amran, I'm currently an undergraduate at Wharton. So thanks again everyone for being here. It looks like we're having full panel today, and good to see all of you. So I'm really proud to introduce our panelists for the Emerging Markets in Fintech panel. First, we have Venkatesh Saha, who is the CEO of Squad, which helps companies build distributed teams all over the world. Previously, he was the CEO of Wise Asia Pacific and led the company's expansion across APAC. Next, we have Manisha Pandita, Director of Product at Jupiter, a neo-banking startup in India. Previously, she was the founder of EasyPlan and Y Combinator-backed Fintech. Next, we have, Next, we have Benjamin Fernandez, the currently CEO and founder of Nala Money. And this panel will be moderated by Ami Prabhu, who is now the managing partner of ASEAN Venture Lab, a leading early-stage investor in inclusive fintech startups globally. She drives firm strategy, growth, and oversees the investments in 60+ companies around the world. We were also supposed to be joined by Stefan, who unfortunately had to drop at the last minute. Nonetheless, we are looking forward to a more intimate deep dive into fintech and emerging markets. Over to you, Ami.
Thanks so much. It's great to be here. Thanks for inviting us and excited for this conversation with a great group of operators, founders working in the space in emerging markets. So maybe just to start, I'd love to have everyone really just start with a quick introduction, a few lines on what your company does and your own background. So maybe Manisha, I'll start with you.
Sure. Thanks, Ami. So, hi, everyone. My name is Manisha. I am a director of product at Jupiter. We are one of India's largest neobanking services. I can't say banks for regulatory reasons, but we're a neobanking service and we offer products across savings account, credit, as well as investments. And we are backed by some of the biggest investors in India, including Tiger, Sequoia, and Matrix Partners. Before this, I was the founder of Easy Plan, which is a Y Combinator-backed fintech app that offered low-risk investing to millennials in India and was bought out by Jupiter about 2 years ago. And in another life, I was a strategy consultant for many years. So I started at Bain in Boston and then moved to a company called Dalberg in India that works mainly in the international development sector. And that's me. I studied economics at Harvard, and that's pretty much it.
Super. Venkatesh?
Thanks, Ami, and thanks to the club for having me here today. So my name is Venkatesh. I'm based in Singapore. I've probably been here for close to 6 years. I spent most of that time at a fintech company that was called TransferWise, now rebranded as Wise, went public last year on the London Stock Exchange. I helped build out Wise's business across Asia Pacific, so almost 15 plus markets in the region, and also co-led the firm's multi-currency debit card program globally, which is now live in about 40 plus markets in 4 continents. More recently, I've joined a Series A company called Squad, which is headquartered here in Singapore. And what we do at Squad is help the entire process of hiring and managing remote teams. But also one of the big areas where I spend my time on now is thinking about how do we do payroll in 100 plus markets so that contractors and people who want to work remotely are paid fairly and on time.
Super. And Benji, over to you.
Hey, what's up, everybody? My name is Benji Fernandez. I'm from Tanzania. I'm actually here right now. And I started a company called Nala. And so what we do is cross-border payments from the US, UK, 19 European countries to 5 African countries today. So we work primarily our initial product is a consumer product that people use to send money back to Africa. We've been applying for a bunch of licenses across the African continent to do cross-border trade. And so that's what we're launching as well. So we've had a business product as well for a couple of months now. I do B2B trade between different corridors across Africa, across Europe, and across the US. For fun, I love football. I'm a Manchester United fan, and that's it.
Important fact to mention. But no, thank you guys all for those introductions. I think, you cover so many different models. You've operated in different geographies. So excited for this. And I think where I'd love to start is hearing more about the specific opportunities you all are seeing and taking advantage of in emerging markets with the businesses you're at. I mean, you don't have to sell me on it. At Venture Lab, we're investing in emerging market fintech companies. We see this opportunity, but what is it that's unique? What's that you all are trying to capture with your work? And maybe we'll start with the opposite order. And Benji, turn over to you.
Yeah, so I work primarily across the African continent. I think Africa is massive. You've got 1.3 billion people here, but it's also a complicated region. So you have over 54 countries here and different policies, different central banks. So it's not like you get one license and you get access to 1 billion people like India or China. But, over here, it's like a different policy for every single jurisdiction that you're operating in. So I think that makes scaling across the continent tricky and difficult because different central banks have different laws and policies of things they want to, manage and keep. So, for example, currency risk is very high across the continent. The dollar is the world's trading currency. And, like many African countries have had the the short end of like maybe not having as many dollars available, their currency gets devalued, and many issues happen to their economy. And so I think those are some of the challenges you see across the continent, but it's a growing region. Ami's been investing for a while across the continent, so she knows and understands these quite well. But I think what I'm hopeful for is what's happening right now, and then over the next couple of years. I mean, the continent's GDP per capita is growing per country as the population grows. Obviously, there's more problems and issues to fix, and this is where technology becomes really interesting to automate and digitize a lot of processes that were historically very manual.
And maybe Venkatesh, you can add from the sort of talent perspective, especially with what you all are building and leveraging kind of the move to remote work. But yeah, what are those opportunities that you all are taking advantage of? Why focus in the emerging markets?
There's a few different questions there. So I think firstly, having now I suppose worked across Asia Pacific for the last 5 years, I'm hugely excited about this region. I think similar to Benji, we have the same challenge of licensing here, which is every sort of 500 kilometers or so, you have a different regulator, different ways of onboarding people, different transaction limits. And it takes the time and the effort to truly localize a product and make it relevant for that particular market that you're operating. But one more thing that's probably unique to Asia Pacific is you also have the two extremes. You have the developed and the first world, which is sort of Australia and New Zealand. You have India, which is somewhere in the middle in terms of its fintech adoption, and then you have Southeast Asia, which is a few years behind. And to try to truly build a global product but make it relevant to all of these different markets, I think has been a hugely exciting professional challenge for me. And I'm sure it is for both the rest of the panelists as well here. But I think licensing apart, to answer your second question around building and finding talent in this part of the world, the reality is even with the current trend of people wanting to have their colleagues back in the office, I think what COVID taught us is that you can work with people remotely, and our belief still remains that you will still go to try to find the best talent of the world wherever they are located. There are certain functions that lend themselves much more easier to working remotely, for sure. And the reality is that the biggest supply of that talent is here in this part of the world, in Asia Pacific, in places like India, the Philippines, Indonesia, and so on and so forth. And one of the challenges that these sort of contractors or remote workers have faced is, how do I get paid fairly? How do I get paid on time? And how do I make sure that there aren't too many deductions on the way and I actually get paid what's stated in my contract? And so that's one of the problems that we've been trying to solve across different dimensions, both from finding the talent, organizing them, and then making sure they get paid. But we face the same challenges that Benji mentioned, which is capital controls are tight. Different central banks think differently, and you have to optimize for each of those challenges. So I don't have a single answer for you today, but it's something I actively work on and think about.
Yeah, and that's such an important point. I mean, we oftentimes hear companies telling us about, in Africa, for example, the massive market opportunity across the continent. And, those of us that are operating, regardless of where in emerging markets, know you dig down, that means lots of different jurisdictions, different regulations, different models, different rails that you would need to work off of. So a lot more complicated, but a huge, massive opportunity as well. Manisha, I'd love to hear from your perspective, both thoughts on this question of just more generally the opportunity, but especially in your role from a product perspective, how do you actually capture that opportunity? How do you think about, the way in which you acquire customers, you build a product, and what's the unique way in which you're doing that in your market?
Absolutely. I think India is a different beast, I think, in many ways. And there's challenges and opportunities. I think it's from the opportunity perspective, the macro remains strong. I think economic growth looks strong in the next few years. So India continues to be a very large economy, obviously a very large population. I think despite sometimes when I've been an entrepreneur now in fintech for over 6 years, you really feel like, oh, it's all tapped out. But if you look at the data, the market is still highly underpenetrated across financial products. So I was, I had done a lot of this research for Easy Plan, and I was looking at it again, and I was like, oh, wow, even now, less than 10% of Indians have actually invested in the market. More than half of our health expenditure is still out of pocket. So I think that the opportunity in India still remains that these problems are unsolved, right? The other big opportunity, obviously, where India, I would say, is like definitely ahead of a lot of other countries, is that the infrastructure that we have built in digital payments is finally beginning to pay off. So I think most people who are in fintech will have heard of the unified payment interface, our mobile to mobile transfer system. And I think that penetration has gone up a lot. And so, that last few years were really marked by the increase in penetration of digital payments. And that ecosystem is continuing to, I think, get better. So we have UPI subscriptions that have come out recently. We have a credit card on UPI that's come out recently. So I think that's the other big opportunity. I think the infrastructure is good, it's getting better, and the problems are still out there to solve, right? I think the challenges in India come from multiple things, and I kind of goes to your second question on how you then build products to tackle those problems. The first challenge comes around building trust. I think, unfortunately, fraud remains quite an issue here, and digital literacy, as well as just literacy in general, across different languages, can often be an issue as well in India. Varying levels of comfort, I think, with written and spoken English, many different languages, and then just general mistrust and fraud. So I think earning that customer trust in a sustainable way is, I think, a big challenge. The second is around data availability. I think compared to the US market that I know a bit better, like you don't have something like, say, Plaid, where you just plug in and you have all their data. And I think that infrastructure, despite so many years later, is still needs development. So when you think about credit underwriting, I think that's still a challenge. And I've seen some innovative business models that work around that. And then finally, and again, I think this comes back, and finally, what remains to be seen in India, we have massive scale in consumer fintech from companies like Paytm, Grow, etc. But I think what remains to be seen is whether we can build sustainable business models around that and really be able to build strong businesses, not just strong products. And I can go into what that means for me as a product manager at Jupiter. Certainly all of these factors, both the positive and negative, have impacted us. But yeah, that's what over the top of my mind, those I think are currently the opportunities and challenges for us in India.
Yeah, it's funny. All three of you, I was trying to focus you on the positives, and you all immediately went to the challenges, which I think are, like, as operators in the space, of course, the thing that you're also thinking about. But Manisha, maybe just picking up on that, as with that product hat on, would love to hear just kind of what's your frame? How do you think about building in India right now? With the unique kind of infrastructure, with the unique the challenges that are there in the market.
Yeah. Okay. So I think, first of all, let's start with the opportunities, since we have lots of those in India. I don't want to be like, oh, it's so hard. I think from the UPI perspective, we are at Jupiter are just super excited about some of these new products that are coming out, right? I think these are tremendous opportunities to reach out to the next set of, I wouldn't say next billion, like putting them in pyramid aside, just including a larger number of customers in India, because credit card penetration, for example, has always been like just stagnant at like 30-40%, right? I think that we're super excited about the promise of these new technologies to get more and more people access to credit, access to investments. So I think that's great, and we're going to jump on that wagon as fast as we can, right? For example, even we did account aggregator service, which is similar to, I think, data sharing infrastructure, jumped on top of that. So those are all very exciting, and we are building on top of them very fast. I think from the challenges perspective, the first one, I think, in terms of trust, and I think that was a question I was thinking a lot about. There's a bunch of things we've done that are a little bit, I think, unorthodox in other markets. So, for example, customer service, we've invested massively on that at Jupiter, as well as Easy Plan. So we have voice as a channel, which I think is almost unheard of in startups in the West. You would never go voice; it's so expensive. But we really felt like trust was a big barrier, and we didn't want people to feel like we were like a fly-by-night operator. So we've invested in voice, in chat, as well as obviously in email and other services. So I think that's a big area of investment for us. The second is that we have kept the barrier to trial very low. Like we really wanted people to try Jupiter. So we're a zero balance account. You can open an account in under 5 minutes. And we tried to keep it so that it's a really accessible service that anyone can use regardless of their I think regardless of their, it didn't require too much trust right at the beginning. So I think that trust issue, and I would say that easy plan as well. Like we made investments, you could start with investing just 100 rupees, like, like just about over $1 for that reason. So people can try it and then they can trust you that way. So I think those are some of the ways that I think from a product perspective. And then finally, and this has recently become more and more of an issue, is looking at economics, right? Like I think for us, as we build as Jupiter, this is very top of mind right now, is it's not just enough for us we have to obviously be a full service bank, right? That's the promise we have for our customers. We have to cover the gamut of financial services, but we've got to do that in a way that it's a great business. So really keeping a close tab on what we're able to offer in a very sustainable way. I think that is something that's become very top of mind for us, and each of our products is focused on doing that.
That's great. And I actually want to build on that and get Benji, your and Venkatesh's thoughts. But this point around sustainability of businesses is obviously the mantra of 2023. I mean, we've always been looking at unit economics at Axion, but I think as a broader market, we've a little bit steered away from that in the VC space over the last year or so. And now you're hearing more and more investors saying, okay, what's the path to profitability? Let's look at unit economics. Is that, maybe starting with you, Benji, but please, the rest of you also chime in. Like, is that the same message you're hearing? And what's your path look like? How do you as an operator, balance the need to keep costs low to bring customers in, be competitive, but also prove out the sustainability of your business?
Oh, yeah, I'm happy to take that one. Yeah, I think there's many things. So for example, like, I think the first thing that people kind of ignore is true market size, right? If you're trying to build a unicorn, like the customers you're trying to serve, you're trying to sell them a product that maybe only a few can afford, truly. Like, you have to start looking at facts, right? So for example, look at the African continent. You have 1.3 billion people. The African continent and Indonesia have the same amount of people that earn over $25,000 a year. Only 1 million people each. So Indonesia has over 1 million people that earn over $25,000 a year. The entire continent of Africa has over 1 million people that earn over $25,000 a year. So if you're trying to sell products like, let's say, buying shares or something like that, like your true market size is significantly smaller than what you might assume. And because there's so many policies and regulation per country that are going to limit you significantly, right? And so, people are talking about like, okay, fractional shares, only it's a couple dollars here and there. Then you have to think, okay, cool, like how much can you actually make from this individual, and what's the lifetime value of that customer? And people bring up the argument saying like, oh, well, Africa is the fastest growing middle class in the world. Yeah, it's true. But like, how long will it take for them to start earning a certain amount of money that's going to enable you to become like super profitable as a business, right? And so these are the questions like we as a team think about consistently. I think one thing that's really helped us at Nala is because we touch hard currencies, in this case, dollars, pounds, euros, right? And so currency losses from FX losses are significantly lower because we're bringing in hard currency. We're dealing with hard currencies. Challenge in countries like Nigeria. Like I had one of my founder friends last year, he was telling me his revenue in January versus his revenue in June. His revenue in June was higher on paper, but because of currency devaluation, when he converted to dollars, it was lower than the revenue in January. And he was like, a little bit frustrated by that. But those are some of the things that people, like, as they're assessing businesses, don't talk about or don't think about collectively. And so for us as Nala, but the way things are going, like by late August this year, we can be profitable if we would like. There's a few things and bets we're trying to make on a few different markets and regions. And so, we're looking at what that would look like for us as a business, but there is a clear path for us as an organization. I mean, we've had this discussion with our board multiple times now, and the more money you raise, the higher the expectations, right? So as any founder knows, like more money, as you see, like more money, more problems. That's very true. You have to think about the responsibility that how are you going to multiply that money and the value of the business significantly through revenue that you're trying to increase and integrate as an organization.
Yeah, I think just to add that, I have my general impression, I could be wrong here, is most entrepreneurs or operators from emerging markets generally focus on what is necessary first when you're sort of building and investing in your business. And you're always keeping a constant tab on costs, whether it's salaries, whether it's the kind of infrastructure you need to build, and making sure that you scale just in time what you need as the company continues to grow. Part of it is as Benji said, is right, we're very realistic on what the market looks like. As a quick example, at my previous company, TransferWise, when you look at India, it's a big number. It's $18 billion that leaves the subcontinent every year. But when you actually break it down into who it is and what are the use cases, it ends up being a very, very, very small fraction of people who send slightly larger tickets but want to be served well. And how do you do that in a sustainable manner, right? Similarly, in my current role, a lot of my colleagues are based in India, where we find incredible talent at still relatively affordable levels. And even though we're a global SaaS company with most of our clients in the West, in the US, Europe, and elsewhere, we find our ability to be able to service them cost effectively from India, both in terms of building the product, but also the subsequent customer service to be something that I guess is a unique advantage to emerging markets, particularly talent in India.
And do you feel, kind of just following up on that, do you feel like you need to sacrifice growth in order to move to, to that sustainability? How do you all view the trade-off there?
I see everybody smiling because it's a question that everybody's probably asking themselves. Manisha, maybe I'll let you go first because I've just talked too much. Yeah.
Nice.
Yeah, okay. I mean, the answer is yes. I mean, of course, you will trade off some growth, but was that good growth is the real question that is being asked now. Okay, well, finally, I feel like economic cycles and VC cycles, like it feels a little bit like Groundhog Day sometimes. So on the lighter side, I feel like we go through the cycle every 5-6 years. But no, I think yes, there is a trade-off, but it's a good trade-off. Like they have to go hand in hand, right? So ultimately we're building a business. I think often like Jitain, who's our founder, will tell me like as a product manager, be like, great, you can build a product, but you're not building a product, you're building a business. And scaling negative unit economics was never a good idea. It's not practical, it's not good sense. So I think like in India, we've seen a little bit of the scorched earth kind of tactics in fintech, especially in payments, but also in other consumer fintech markets. And I think we're not seeing that anymore. So for us, I don't think it's either or. Strong growth, and we've seen strong growth of the last few years, gone from like 0 to almost like 3 million accounts in just a couple of years. But it's driven by user demand, by building something people love, in the words of YC. But I would say strong businesses go beyond that to building something people will pay for. And that's a reckoning that we've started to kind of wrap our heads around pretty early in our journey. I think even despite the fact that we're very well funded, I think we've kind of drawn that conclusion very early and started to monetize and broaden our base of products very early. Like I think 5 years ago, if I'd seen this business, it would have built slightly differently. But we, for example, have started cross selling pretty much on like very early in our journey. I don't think we would have seen that earlier. 5 years earlier, I don't think that would have been the case. So yeah, I think it's a good reckoning, and we are certainly part of it. We've had to respond to that. But I think that it's a good thing. It's not a bad thing.
Yeah, I think just to add to that, and I'm not sure if the other panelists also using this word a lot these days, but it's really all about the brutal prioritization. What are some products and features that you can monetize relatively quickly? What are things that customers actually need versus want? What is stuff that can be deferred 6 months from now? And those are all very good, healthy conversations to have, because I think that the necessity and the scarcity really forces you to build something that is even better, that you might be able to do when capital is abundant and you're not forced to make these choices.
What advice would you have to the early founders who might be listening, who maybe don't have the benefit, right, of sitting with, multiple products that they've tested in market to do that prioritization exercise? How do you start off and you're getting, call it your first 2 million, to figure out what to build and how to grow it? What should they do?
I actually think now is the best time to start a company, to be honest. Like, I really think so, because you're getting more realistic valuations. And, for example, if anybody who raised between 2021 and maybe parts of 2022 are now, a lot of people are trying to live up to their valuation. Like that's something, frankly, we have. That's a problem we have as a business, right? So like I'm trying to 3 to 4x revenue over the next like 16 months. And it's hard. And in order to just even like be better than my last valuation, right? Like, and some companies have the privilege of being able to be in that position to even have the runway to do that. Some companies don't, right? And so like many companies are going to take a bridge round and a down round, for the next couple of months. That's going to happen. So I think right now is the best time to build a company. And I think what I'd really, I don't know, I always tell my team, like, fall in love with the problem. Like, I think that was what I'd focus on more. I think the idea doesn't really matter. It'll evolve over time. It'll change. The idea today is going to be very different from the idea 1 year from today. And I think what's the thing I always tell other early stage founders, what's the easiest, fastest, and scrappiest way to just start? One of my friends here in Nairobi, he got into YC by building like a large grocery delivery service from Google Forms and Google Sheets. Like that's it, no software, no app, nothing. But got, up to like was moving 25K a week in transaction volume by the time it was just super scrappily built. And so what's the ways you can test them on the easiest, fastest, and simplest way? Like getting $2 million, if that's what you're getting, that's a lot of money. And like be responsible for it. Like when we were raising our last round of funding, we raised 10 million with 7 people on our team. And when we were raising money, like every VC asked us, Benji, how big's the team? And I would tell them, take a guess. And everybody would guess 35, 40 people. And when I told them 7, they wouldn't believe me. And then as soon as that happened, like then a term sheet would come. We had in our last round, I think we had 5 or 6 term sheets from some pretty large funds. But because like really try to be like frugal about the money you're spending, try to be like, okay, this like every dollar matters in the business always, because every dollar you spend, you got to earn back somehow. And I think keeping that in mind as a business from the early stage is really important. And then when you start growing the business, and like where we are today is we're thinking about optimization and efficiency, right? Are we efficient as an organization? Are we efficient as a team? Like some teams and some companies globally need to trim down because the more people you hire, maybe some people hide behind some other people's work, right? And maybe we're not as efficient and functional as an organization. And like finally, like really asking yourself, are we measuring what matters? It's so easy to get caught up in metrics that don't matter and BS metrics that aren't going to mean anything for the business. And really asking yourself that question honestly is something that's really critical, I think, especially right now more than ever.
Great advice. And Manisha, Venkatesh, anything you guys would add?
I'd only say, in addition to falling in love with the problem, as you iterate, just make sure that the problem that you're solving for has a large enough addressable market opportunity for sure. I think certainly in emerging markets, there are still a number of white spaces, even financial services where all of us are, have a number of sort of vertical spaces that are large enough, attractive enough, and still need to be solved at scale. So keep that also at the back of your mind. I think that is the perfect intersection, and fully agree with Benji. It's an incredible time to start a company.
Yeah. Okay. So I think when people were going to hear that, oh, it's an incredible time to start a company, I think a lot of people are like, yeah, sure, why not? Because now you have the funding. You're like, it's an incredible time to start. But as somebody who actually did start a business that had no revenue model, I can tell you Benji is not lying, right? Like we started at a time where frankly we're like, oh, like we're growing 10% week over week. That's like the magic number everybody wants to hit. Wonderful. It's like no one's paying for your product, Manisha, right? So, so it'll save you a lot of time, personal time and personal pain if you realize from the get-go that you're not building a product, you're building a business. And I think this is the market condition and under which like you never have the luxury of forgetting that. And I think that's a really good thing. You'll use your time better than certainly I have used it in the past. Not to say great product, a lot of customer love, no business model, not sustainable, right? So no longer will you have those kind of situations. And people won't just assume that, oh, you're just going to raise more money until somebody buys you out. Like I think none of that thinking, which is not useful, exists anymore. So I think Benji's not lying, and neither is Venkatesh, because I think some people were like, yeah, sure, they're not lying. I think it is actually a good time to start a company in that sense.
Completely agree with that. Maybe just picking up on another challenge that Manisha, I think you brought up earlier, but fraud is clearly a topic that I think is coming up more and more in fintech, especially in emerging markets. I mean, in developed world, there was that analyst who came out, that short analyst on Block, and sort of questioning Block's accounts and customer numbers. Benji, you probably know in Africa, there's been a case with another early stage fintech company who was issuing accounts for fintech companies and had to shut down because of major fraud. What are you seeing in your markets and your models, and how, as operators, are you managing against fraud? What active steps are you taking?
Sure, I can start. I mean, fraud's a global problem. In every single country in the world, there's mass fraud. And I think it's challenging. It's also kind of creepy and scary because like you want to start a good business and solve a problem for people, and then all of a sudden like fin crime becomes really important, and you have to like prioritize it, dedicating a whole bunch of resources just to fighting fin crime and so on. And yeah, I think I think one of the things that I really try to think about in the story that came out recently, about the card issuing platform, just really taking a step back, and every customer you take on as a business can cause you a lot of problems. When we add business customers to Knowledge for Business, we do deep like KYB for them, like really trying to verify, is this a real person? And you'd be surprised. We have people try to like pretend they're like some agricultural company, but they're like their books and numbers make no sense. And you're like, yeah, nah. And they'll do like weird stuff, like even show up at your office and stuff like that, or try to take you as a CEO out to dinner. And it's just, and so like it's weird. And a lot of that stuff, people talk about that stuff happening in Africa. One of the fun facts for you, Ami, is a lot of the fraud that we've seen of people trying to attempt, in a lot of my friends' fintech companies, comes from London. And it's like people they work with in London who are managing people maybe in Nigeria or whatever other country, and they work collectively together, and people blame like, oh, Africa has fraud, but I'm like, actually, like who's leading and organizing that? Like we'll find people like signing up from the UK trying to lead and organize crime globally, right? So I think what I want to say is every country has its fraud globally, and there's cases that I think my advice would be, like, I don't want, if you're an early stage fintech founder sitting in this, listening to this right now, I don't want you to be scared of it. I just want you to be mindful and don't be ignorant of it, because even before you launch, you're already targeted. And just keep that in mind, and just don't be ignorant. So not everybody, like if we have a saying in our office, is every customer is guilty until proven innocence. And like no matter who they are, like you could be going to the mosque with them or church with them, like doesn't matter. Like, for us, like you just have to protect the business at the end of the day. And even if they're your friend, it might get awkward in situations or, meetups or social settings where like you're at a fintech happy hour and that person who was like trying to commit fraud on your platform shows up. It'll happen. And you just have to put the foot down and protect the company at the end of the day. Yeah, I think it's the most important thing.
Yeah, I would say, it's not something to be scared of necessarily. It's just something to manage. There's a couple of things, and there's a scarier fraud. So you'll see a lot of, like, say, first party fraud where somebody, and this is very unique to India, I think, because the level of digital and frankly, just literacy in general can be quite low, especially in rural areas. So you see both first and third party fraud, right? People stealing other people's identity and then committing fraud, or people just committing fraud against like others. And there are certain like very well-known platforms where that happens, and they'll often utilize a payment service or a banking service, right? I think it's just the reality of the market that you have to be really aware of. I think there's a couple of things. There's a couple of things. So the regulator in India is pretty strict about this, and I think given what we've heard, sometimes you do sometimes feel like, oh, they're often too strict, but I don't think that's a bad thing again. So you have anti-money laundering, just AML kind of laws that are quite strict here. And when you work with banking partners, as well as any other regulated entity, an NBFC or whatever you are, they will ensure that you are meeting those guidelines. So that's good. So you don't have to get scared as an entrepreneur either, right? Like your partners will generally make sure you're on the right side. Your payment gateway, all these guys will help you do that. The second thing, there's a ton of great tech out there for fraud management, both KYC as well as, there's a lot of on transaction fraud as well. There's a ton of great technology that you can use. There are lots of great companies that offer services. And, at Jupiter, when we were scaling up, we had to be like quick customers, a lot of them. There is a lot of great tech for that. So I would say that, and then finally, customer education in India, for lack of a better word, is still important. Like telling people not to share pins and passwords. Like we hear a lot about that. You'll see that in like Indian media everywhere, and sometimes you laugh about it, but you see it every day around you. And I certainly saw it a lot when we were scaling up at Jupiter and at EasyPlan as well. So that becomes important as well. But it's not that we're scared of, but it's something to manage, I think, from day one and know that it'll happen.
Yeah, I think fully agree with Benji here. I mean, if you have even the slightest bit of doubt, freeze somebody's account, get all the facts. I know it'll be a little bit painful from a customer experience point of view, but you're much better. You will keep the entire platform safe. You will still maintain trust with your sort of overall customer body, but it's better to be safe than sorry.
Yeah, absolutely. One more challenge I want to get your thoughts on, then we'll go back to the kind of the positives and the future outlook. Well, hopefully the positives. SVB. It's funny for the friends of mine who think of me as, oh, you work in emerging markets, so probably didn't affect you, not something you had to think about. We know that there were direct impacts from SVB, as well as ripple effects. And so I'm curious to hear from all of you, how, if at all, were you affected, or do you see those ripple effects? And similar to the last question, how are you managing those kind of risks differently now post Silicon Valley Bank?
Yeah, so we had a team social on Thursday, and it was in London. And I get a call from one of my board members. He keeps calling me, and then this is like I was going to bed and he just keeps calling me, and I was like, hey, what's up? He's like, can you get out of bed right now? And I was like, super weird, like awkward, so I'm like, okay, cool, what's up? And he's telling me like, go grab your laptop, let's make a wire transfer now out of SVB. So I obviously look at the phone 3 or 4 times. I'm like, am I sleeping? Am I dreaming? And then I was like, it was a really weird interaction. So we bank with SVB. That's where a majority of our money was. So when we raised money, that's where most of our money was stored. So, and we moved the money to different countries depending on usage and operations costs, right? So all of a sudden, I call my COO, we try to get on the phone. He's in Nairobi and different time zones, 3 hours ahead, time difference from the UK. So super late. And try to wake him up and hey, we got to move this wire. And then we moved the money to another bank in the US. And literally 30 minutes later, I couldn't log into our Silicon Valley Bank portal. And I was like, whoa, and, had obviously the next day is we're still processing what just happened. And a lot of my friends were affected by that. A lot of my founder friends who even operate in Africa were affected by that, who raised US VC funding, who had SVB bank accounts. Right now, most of them have got their money back. I talked to one last night who's got only half of his money back. So he's still waiting to get the rest. But things like that just happen. And all of a sudden, not just happen expected every day. What we shouldn't have to have 3 or 4 different bank accounts in the US, out of all markets, right? And banks are the system that you're supposed to be able to trust with that stuff. And unfortunately, when that happened, we really started to think about okay, should we have 2 or 3 different banks? And what does this actually look like? And how are we protecting our business? We have multiple bank accounts in Africa, over 40 bank accounts in Africa, but for our primary funding, we expected that SVB to be one of the last banks to go down. And so I think those risks are scary and affect people. But I think they can happen in many countries in the world. I've seen bank runs in Africa multiple times in my career, and that's happened. And I think, over the next couple of years, we might see more M&A happen in the banking space globally, is what I think will happen. So yeah, that was our experience.
I think for us, we literally just spent the weekend trying to figure out which of our customers had primary accounts or paid us from their Silicon Valley Bank account. And as a Series A company, that revenue is critical for us to be able to manage our cash flows and think about what kind of sort of future funding we might need. And so at the end of the day, we realized it was a relatively short list. but it still gave us some pretty sleepless nights until sort of early Monday in Asia. We knew that the bank was sort of going to be safe. But I'd say the only marginal positive, if there is any, I think for us as a business in emerging markets, and the one that's helping with find sort of better quality, but in some cases lower cost talent, is we've seen some of that demand continue to accelerate, where companies, particularly some of the tech companies in the US, still need to grow. They still need people to help them do it, but they're much more open to finding people halfway around the world who might be just as amazing, but based on cost of living, etc., significantly cheaper than if they had to hire them in San Francisco. And we think that trend is going to continue for some period of time. So it's definitely been a bit of a positive and some tailwinds for us.
Anything you'd add, Manisha? I know maybe a different situation coming from India.
No, I think we're also a YC company, so we had some of that as well. So cash management, I think most startups started to think about that. And in India, I think a lot of people now feel like, oh, the regulator, like they get a lot of flack sometimes, but now we're like, okay, maybe they're not so bad. But I think the other thing which is interesting and goes back to the point about, being frugal, and what I think SVB also told us, that economic stressors can come out of nowhere. I think like right when the economy is thinking, oh, okay, we may not go into a recession this year, you see something of the scale of these kinds of bank failures, and you realize, okay, this could change very quickly. So again, coming back to building a sustainable business, being frugal, I think that's what was top of mind for us here in India. If you were, if you didn't have, even if you didn't have money directly in SVB. So yeah, that's all I would add.
Yeah, no, that all resonates. And one thing we're seeing on our end is, before it felt like the CFO role was one that companies would push out a little bit more and more and say, oh, we can use a fractional CFO, or, we've got an accountant. But I think this is sort of a lot of teams are now waking up to what the actual role of a CFO is, what the risks that they help manage are, and thinking about what that function looks like more generally. So that's just something else we've seen as well. So maybe with the last few minutes we have here, I'd love to get your perspective on something else that's flashy in the news. AI is something everyone is talking about. How real, as you look into the future, is it for your own businesses, but in the fintech space more broadly? Where do you think we'll see more and more conversation around AI coming into the space?
Happy to start. I just want to add a quick comment from the CFO thing. I mean, early stage founders, I don't think you need a CFO at early stage. So if you're in the room, please don't take the money you're raising and go and hire a CFO tomorrow. But I think Amit's point is very valid across as your company is growing and scaling, really thinking about the risks, that especially if you're in fintech, right? The more volumes you're moving, that's where money can get lost and things like that. You'd be surprised how many companies have clean books properly and do reconciliation. Well, it's really tricky, right? Venkatesh was at Wise, we're at Nala, we do 105 corridors for transactions, right? Try closing the books with 3 accountants for 105 corridors every single month. It's complicated. It's difficult. So make sure that you guys are paying attention to that stuff, especially as you guys start to grow and scale. Now, regarding AI and what does that look like in fintech, I think it depends on the customer base you're serving, right? So, for example, I'll give you a fun example. So when we were what sort of ways do many fintech companies maybe use some element of AI today is maybe chatbots for responses with customer service. Maybe that's the one that's more common for that people are using that today. However, most chatbots suck. Most chatbots are not language, don't take in multiple languages. Manish is in India, where there's an insane amount of languages in every single state, right? And region. So we're in Africa, where there's hundreds of millions of languages. Tanzania alone has 138 dialects. We have Swahili that covers 100 million people across the continent, but there's so many different languages, right? So what happens with that with financial services? Because language builds trust, right? And so when is it going to get to a stage where language is good enough, where things that help you with decision making are going to create enough trust? Now, I'll give you one fun fact. When we started Nala, our chat response service was called Mama Nala because it was like more responsive to like our sort of culture and people that people would get like Mama is like, people feel safe that way. And then like even using names. So I was Mama Nala. Most people didn't know I was Mama Nala, but I would like create a name and I was like Rose under Mama Nala. And so I bumped into because we were a small team, we're like 3 people. I bumped into some lady at the airport. And she's like, oh, hey, Benji, like I use Nala, blah, blah. By the way, tell Rose she's doing an amazing job. Look, I was even speaking to her in Swahili, whatever. It's like showing me chats. And like, I remember messaging this lady last night on our intercom portal in Swahili. And like, obviously today, like we're much bigger, like support team. But, at the time I was like, okay, what ways can we automate languages is the big question that we have today, right? Like with different services, but ways that people build enough trust to the service versus just like assuming. Now, the other difficulty we see is people want to speak to somebody on the phone. Like, culturally across the continent, people just want to pick up the phone and talk to somebody, right? And so like using that specific example of chat, like I think it's trickier and people don't want to be involved with chatbot. So I think AI will I'm hopeful and optimistic about what it creates, especially in the fintech space with decision making, the ways it's going to like create suggestions to save people money. I think that's really exciting. I hope it helps us reduce costs as well as a business massively on things that we can really pull data and automate more. The more data we start to collect across, even predictions of pre-funding accounts and like treasury across the region, and looking at like, okay, this market is gonna, adjust its FX very soon. So how can we make a treasury bet that's gonna save us money, right? And I think there's a lot of things I'm really excited about. I think AI has been early days for many years now. Like I think Chat GPT and OpenAI just kind of push it forward and made it more visible to more people. But yeah, I'm not jumping on the next bandwagon to try to build what's Nala's AI vision tomorrow as a CEO.
Yeah, I mean, I think Benji is absolutely right. I think the one area that I do see it work quite well in is actually KYC and fraud detection. So we have ARML models that will scan documents and tell you if this is the same person, and they work fairly well. I think underwriting was always one that people felt that magic would happen. It has not. There's just simply not enough data. So that I think the promise still remains. And I agree that there is a lot that what I'm excited by, and we have started experimenting with it, is so the thing with financial services, especially banking, is that it's a very multimodal service, right? So the person can come to your app trying to send 500 rupees. They could also be looking for investment advice. They could also then be trying to pull out a receipt. So there's a lot of different use cases within an app. And in that situation, I think research and AI-driven platforms can help. But as Benji mentioned, the big barrier we face is language, because these models are not meant for bilingual or even, and frankly, not even non-English speakers, right? So that is definitely a huge burden. But I think that'll evolve and is super exciting from a financial advisory and financial and just like because these are complicated products. There's a lot of different details that customers ask us, and I always maintain that like if it's just information retrieval, computers are way better than that than humans. So if we can solve the language issue, then I think there are some really powerful advisory as well as customer service products that can be built. But in the area of fraud, there are already some products that use them quite well. So mixed bag, I think. Definitely here to stay. So
yep, got no more to add. I think fully subscribe to what the other panelists said.
Super. Well, then maybe to wrap us, Venkatesh, I mean, we've kind of already talked about the future outlook, good time to start a business, looking at AI, but not any time in the future. But any last words, maybe to wrap us? I'll leave it to you, Venkatesh, on future outlook in fintech, in emerging markets. What are your thoughts?
I think from where I sit in Asia Pacific, I'm just amazed at how digital this part of the world already is. I think in the last decade alone, we've gotten people comfortable with managing financial services on their phone, getting paid onto an app on their phone, receiving money internationally on their phone, and paying locally with QR codes. We now have governments that are connecting payment systems to one another. So Singapore just connected with India, they've connected with Thailand. It was just announced today that I can take my local bank in Singapore and scan a QR code in Malaysia, and I wouldn't need any further external intervention. I don't need to carry a credit card or anything else when I go abroad and spend. So I think the kind of physical infrastructure that's being built in this part of the world, faster payments, better cross-border payments, is just incredible. And I think the opportunity for fintech entrepreneurs to come and build on top of this infrastructure, whether it's UPI in India or Fast here or whatever, Napas in Vietnam and so on and so forth, I think is still incredible, notwithstanding all the challenges that were mentioned in the beginning, which is the time to licensing takes a long time. It needs a bunch of regulatory capital to get you off the ground in the beginning, certainly to be able to get some of these licenses. But if you're able to raise some of the money and you have a large enough problem to solve this, there is a huge market here that is digital first and will continue to grow.
Super. Well, a great way to end that basically massive opportunity in these markets, massive opportunity in emerging markets, but not for the faint of heart, and for keeping your eyes wide open to the challenges and managing them as you go along. So really want to thank the three of you for your time and for your thoughts here. It's been a great discussion.
Thanks, Ami.
Thanks, guys.
Thank you.
Okay.
Bye.
Bye.
Hey everyone, welcome to the panel.
Thank you very
I think we have another 3 minutes before we kick off, right, Sonal?
I was gonna say, Daniel, thank you for the notes on banking as a service. It was a great read. In fact, I'm actually going to steal it and share a bit for an upcoming meeting I'm going to have.
Feel free. No pride of authorship on my point. Go for it.
I try to weave a little bit in here, but I think this is more about embedded in terms of banking as a service, but I certainly will allude to some of it. I think the things that you talked about where we had to do everything on our own versus nowadays, that is like totally.
Yeah, you know it. You know it very well.
Too well. I'm jealous. I wish I could go back in time. But
start another company.
Oh boy, it is 10 p.m. So I'm a little delirious as always. So I just might do that. I think we're still waiting for Uday. Is that right?
Yeah, we're waiting on Uday, and then I think we can start at 10. Yeah, I guess we can give him a couple minutes.
Okay. I apologize, but I did make some minor changes last minute just to try to shorten it when I found out that we actually have a little bit less time. So anyways, I'm sure we'll be fine. Nothing difficult here. Hello.
Hello.
Great. I guess with that, we can kick off. So for everyone tuning in, I'm Rhea, and I'm an MBA student at Wharton. I'm excited to present this next panel on embedded finance. Through this discussion, we will explore embedded finance through the lens of 4 operators on our panel today. The products they're building span industries from hospitality to transportation, and span use cases from payments to lending to charge cards. Today's conversation will be moderated by Hui Lin, a partner at GTV who joins us from Singapore. Saying Hui is an experienced fintech operator is an understatement. Her experiences include serving as the founding COO of a firm, as the company scaled from 5 to 500 employees, and serving as the president of Asia for Flexport. She also serves on the board of payments company Niam and Hang Seng Bank. With that, I'll hand the mic over to Hui to get us started.
Thank you so much, Ria, for the opportunity to share something that is near and dear to me. In fact, one thing that Ria didn't mention is that my first foray into fintech was actually a company called PayPal. And in fact, it was the eBay customers who actually took it upon themselves deciding to embed PayPal into eBay, and the rest is history. And just to sort of set the context a little bit, if per Bain in 2021, about $3 trillion worth of money is processed this way. And this is expected to double and continue to grow over the next couple of years. This value chain, right, includes lots of the players, and we'll hear a little bit more about it today from the operator themselves. But this better together notion, I don't think it's going to stop here. In fact, I think it's going to continue to grow and evolve. And so I couldn't be more excited to really now turn it over to y'all to tell us a little bit more about yourself and then the company you're building. And then, of course, on with it we go. And maybe we just start in alphabet because I'm boring and I like that. But Daniel, maybe you can get started. Tell us a bit more about yourself and the company you're building. And then I'll call on the rest of you and off we go.
Sure. Thanks a lot, Yui. I'm Daniel. I'm the founder and CEO of Coast, which is a Series A startup in commercial payments in New York. Is backed primarily by Excel and Insight, but lots of other great folks as well. And Coast provides expense management and charge card solutions. So think similar to what you would get from Ramp or Brex or Divvy, but focused on the specialized needs of companies that operate fleets of vehicles. So when you give the plumber who works for you, the company credit card, when they're taking the van out to go do their jobs, you need control, security, visibility, reporting. You need specialized software. There are a couple companies in the US that do this. They're huge. They're hugely profitable. They don't always treat their customers as well as they could. And they're built on decades old technology. And there's an opportunity now for various reasons to do something better, which is what we've built. We're 45 people in New York and growing our business very quickly. Prior to this, started a company called Bread, which is consumer BNPL, as the kids call it these days, I think. Though back in the time, we called it the decidedly less catchy point of sale consumer purchase finance, competing with the likes of Huey at Affirm and Klarna and others. That was a venture-backed business. We raised a little more than 100 million in venture capital from Bessemer, Menlo, Chinovik, and others. We sold the business a couple of years ago to Alliance Data Systems for a little over 500 million. So a happy outcome after some hard work. And prior to that, I was a software engineer in financial services for a number of years, went to law school, business school, did some stuff along the way. And really happy to be here with this really great crew. I'm an investor in a number of BaaS and infrastructure companies. So happy that David's here because I can pump units. So really happy to be here. Thanks for having me.
Well, David, you're up next.
Great. I'm Dave Sinsky. I'm the VP of Lending at Unit. Unit is a Series C company that's focused on building infrastructure for embedded finance. So hopefully we have some relevant things to say for today's discussion. What it means to build infrastructure for embedded finance, really we serve two constituencies. First and foremost are software companies that are looking to build financial features into their products. So whether these are deposit accounts, debit cards, credit cards, payments, and lending products that a software company wants to bring to market, we help them with the technology and compliance infrastructure to do so. And then on the flip side, we work with a network of regional partner banks who see software companies and fintech companies as opportunities to grow their businesses. And we help them bring their products and their business to market, which really requires a tremendous amount of oversight. So when they are talking to their banking regulators, obviously that's a hot topic these days, that they can have confidence that the products that are being brought to market through these partner software companies are being done so in a compliant and thoughtful manner. Previous to Unit, I was at Opendoor, which is a consumer real estate fintech. I was at some other software companies and started my career in iBanking and private equity before leaving the dark side.
Excellent. Khalid?
Hello, good morning. My name is Khalid Maniri. I'm co-founder and CEO of Selfbook, a Series A company backed by Tiger Global, Amex, BTV, and so on. Selfbook simplifies direct bookings and payment for hotels, enabling them to maximize their direct revenue while providing both hotels and guests with contemporary and secure checkout experience. That includes digital wallets. Before Selfbook, hotels couldn't really accept digital wallets. And with the introduction of seamless payment in the travel sector, it was bound to happen. So Selfbook was a natural progression. In under 2 years, our products have become essential components for the hotels and their workflow, particularly around payment automation and the automation tools for them. And obviously, we provide a remarkably better guest experience and booking experience. Prior to Selfbook, I worked on mobile commerce during the early days of iPhone and consumer mobile adoption. And those days relied on heavy payment sort of tools, pre-Stripe, if you will. And obviously, the world now have moved to adopt payment and fintech within all services. And so we've brought in that sort of mentality into Selfbook.
Excellent. Uday?
Pleasure to meet everyone. Uday Seth. I run a few different functions at Flywire. I run corporate development, business operations, analytics, and strategy. Just by way of background, Flywire is a recently public company. We started the company in 2011 and went public about 2 years ago. The core of the company is really focused on enabling clients to receive complex payments. So if you think of sort of the pain points of an international student, you'd have to traditionally send a wire or bring a suitcase full of money across borders in order to pay your tuition. We, in effect, digitized that whole end-to-end process. What we realized is we're really good at helping enterprises collect large payments being cross-border, there being an element of reconciliation, there's just an intrinsic amount of complexity. And if you think about where Flywire is in the payment ecosystem, there are amazing companies like PayPal, Affirm, Klarna, Adyen, going after e-commerce, going after sort of retail, going after mobile payments. Ultimately, our vision is to do something similar, which is to make payments more seamless. But what we've done is tackle sort of harder industries, things like education, healthcare, B2B payments and travel, and B2B payments more broadly. Payments that are typically more analog, more check, more sort of cash-based in nature. So we have quite a different focus, but again, similar premise in terms of sort of having payments become more in the background. So pleasure to meet everyone today. Just quick background, before Flywire, started my career also on the dark side as an investment banker in private equity. Then transitioned to PayPal. I didn't have the opportunity to meet Huey, but it was also at a very different stage in PayPal's journey. And then also have the distinguished sort of pleasure of having been a Wharton alum. I graduated in 2017.
Amazing. It's incredible to have everyone here, and even just listening to your intro, I hope everyone is getting sort of a sense of the different type of embeddedness, right? Clearly, there are companies, universities, for instance, with that bag of cash that you're talking about, Uday. I definitely have cousins, so I can certainly relate to that, and how you're helping universities be able to sort of really address the customer's needs much better, or in hospitality, but to a certain extent too, the like of Unit, right? Maybe that's a good place I wanted to kind of start, because that's a different kind of embeddedness, where fintech companies, as I mentioned earlier, back in the days, the early days when we were starting to build out, everything had to be done in-house. There was no Unit, no Alloy or anything of that type for us to kind of rely on. And so just to start kind of understand, just peeling the onion a little bit about your product, right? Understanding a bit more about who are you leveraging, because there are other embeddedness that comes with putting together a fintech nowadays. I love to start, and just, anyone who wants to go and maybe just tell us a little bit more about some of the other folks that you're working with, or the infrastructure rails that you're relying on nowadays to deliver what you do. Why don't we start with that? Who wants to go first?
I can go. So we do card issuing. So if you're giving customers a credit card, you need like a few different kinds of partners. You need an issuer processor to provide you with the software that connects to the Visa and MasterCard card networks. You need a BIN sponsor bank, and also the originator of the credit receivable. So somebody who understands your business and who allows you to sort of ride the rails to get onto the Visa and MasterCard networks and issue credit to your customers, and you need the card network itself, Visa or MasterCard, to partner with you. It's in our case a charge card, so you need customers to pay you back, and they'll do that by either ACH debits, meaning drawing from your bank account, or sending us wires, or frankly paper checks, unfortunately. So you need a bank to underwrite that kind of payments business and the risk behind it. You need to do decisioning on credit, fraud, and sort of know your customer and anti-money laundering regulations. And so you mentioned Alloy, for instance. So you need some kind of orchestration layer for getting the data from the dozens of different sources that you might need to figure out the signals of that risk. And you're going to need some kind of way to ledger and keep track of your customers' balances and where to allocate the payments that are coming into various accounts. So there's a lot of stuff that goes into it. To your point, Yui, like some years ago you would have had to build all that yourself. Happily, we're in some better times these days. But that's what we use here at Coast.
Excellent. Anyone else want to share what's behind the scenes and how your product come together?
I'll jump in here too. So if you think of sort of what the core of Flywire is, we're serving sort of needs of industries. And one of the things we've seen is that the vertical applications matter a lot to clients, like how well you can sort of cater to a university, how well you can cater to a hospital. So our premise is, if you build good vertical application, you can find infrastructure to sort of support it on the fintech side. So interestingly enough, we are partnering with a lot of banks that sort of help us move money from geography to geography. And we're also partnering with the likes of Adyen and sort of other card processors on the back end. They've done a lot of the hard work already in terms of things like credit control, risk, payment processing. So it makes our lives a lot easier, and to sort of embrace the ecosystem rather than sort of build it entirely on our own.
Got it.
Yeah.
And Khalid?
Yeah, I can go. I mean, as a platform position at the intersection or the nexus of fintech and hospitality. So our distinct advantage that we provide to hotels is payment automation and orchestration. And so we do, similar to what they say, we do partner up with PayFacs, whether it's Adyen or Stripe. They've done a lot of the sort of, they built the rails, the necessary rails, so we don't have to reinvent that wheel. But the secret is how can we create this many-to-many sort of matrix, regardless where a hotel is located. So we work with brands that are around the world. So you have a single brand that you have a place in London, but also another hotel in Jakarta. But Jakarta is not supported by the same sort of payment service provider. So how can we work with multiple, sometimes local payment service providers and orchestrate that to send the payment securely to the property management systems? Today, all the card data is handled manually. If you go to a hotel website and you enter a credit card that doesn't use self-book, all that data is raw data, and someone is reading it and then re-entering it in their local machine. And historically, hotels have depended on isolated and siloed, labor-intensive processes and systems. And so doing this orchestration, where we take the guest card data securely and pass it through to the property management system and processing it, is where we sort of stand, and we rely on other payment partners or other sort of industry systems that already exist. And so that's what makes it unique.
Yeah, no, building fintech now does make me, I have a bit of envy, and seeing, like, for instance, how quickly someone can issue a card as an example. But I wanted to turn over to David a little bit, or David, to just tell us a bit more, right? Because there are times when, even though there are solutions out there, you may decide to actually take it on your own. And so I'm just curious to hear, as you talk to your customers, the decisions between buy and build, right? What are some of the things that you know that you're hearing from them when they're trying to make these type of decisions?
Yeah, absolutely. I mean, I think we're an infrastructure company, and so when I think about what does it mean to be an infrastructure company, it's really taking advantage of the fact that many companies are actually solving a common set of problems. And by definition, that common set of problems tends to not be a competitive differentiation. And so when we think, what do companies want to build? They want to build as much as possible where they have competitive differentiation, and they want to build as less as possible where it's a commodity or they don't have competitive differentiation. So I'd say that's the framework that we start from, and then everything falls out of that. So we start with, when we think about what does it mean to work with a bank partner, first and foremost, it's how do you integrate with that bank, and there's really kind of two options. One is you can sit on top of that bank's existing technology, which unsurprisingly often is kind of old school 1980s technology, which, while on some level it's easier to sit on top of existing technology, when you're sitting on top of 1980s technology, that can often slow you down. So what we've chosen to do is actually kind of build side by side to that technology. We do all of our own ledgering, we do all of our own payment rails. And so when we thought about where do we want to build, we built that, but that allows our customers to not have to focus on building these kind of more commodity pieces around ledgering. What we've also seen increasingly is that we start off as just being an API-based company. So if you think of kind of the classic Twilios and Stripes of the world that were infrastructure companies, their product is a suite of APIs. And I think Twilio is also a great example. What you see is over time you move from simply building APIs to actually building user interfaces, because even though user interfaces are customer facing, there's a large surface area of these user interfaces that are actually end up being fairly commodity. So you think of in the financial services world, you think of when you go to your online bank account, you're looking at, what are my recent transactions? What are my balances? How can I make a payment? And oftentimes, especially in the world of embedded financial services, those user experiences are not the competitive differentiation. And so we've increasingly actually, what I would say, moved up the stack and said, even as we move into these customer-facing interfaces, these moving up the stack, how do we identify those areas that are commodity and build that on behalf of our customers, and then leave the open space for where there's competitive differentiation?
Excellent. I'm going to turn it back to Daniel a bit, just because he's offering a product to something that's existed for a long, long time. And as you already alluded to, that he's obviously leveraging sort of other folks to sort of help him grow his business. But just tell us a little bit more about how your approach is different from some of the legacy players that exist today, and how that has sort of shaped your business and how you've been able to grow differently.
Yeah, I think that pointing out that this is like a product category that already exists is like that's not by accident. Like I like to think about both of the companies I built as like basically taking proven business models, that solve real problems for real customers that are shown to work at real scale, and just making them 10 or 100 times better by reimagining what they would look like if they were born online, native to the internet, speak the sort of interactive and digital language that we've come to expect in every other aspect of our lives. And you and I built businesses in sort of consumer purchase finance at the point of sale. Well, that's been around for 2,000 years. I mean, like it wasn't necessarily designed for e-commerce. And similar here with sort of the specialized controls that you need in fleet payments, there are a couple of companies in the US that are absolutely giant who are doing this sort of specialized thing, but they weren't designed for a modern and digital experience. The approach that we take sort of when we think about what we do different is first, universal acceptance on an open loop card network. I talked about Visa and MasterCard. The incumbents in the space have typically designed proprietary, specialized networks, which get the kind of data that you need for this particular use case, which means that they've had to go out and build relationships, integrations with fuel brands and truck stops and gas stations, whereas for various sort of reasons now, in terms of advances in how the payment networks operate, we're able to ride their rails and just market directly to the 500,000 small fleets with at least half a dozen vehicles in the US, and that's been very exciting for us. There's sort of the fair and transparent pricing. Financial services has kind of a bad rap for good reason on sort of how they treat customers in terms of the financial product. And again, similar to Bread and the Firm, like really trying to be like very straightforward and transparent with the customer, as you would expect in a consumer context, but taking it into a commercial context. But then most importantly, like a modern, sort of real-time expense management platform, like I said, native to the online world with the kind of great digital experience on desktop and mobile web that we take for granted everywhere else, and taking it to this industry that's been left behind, I think, by a lot of financial services, and then finally, great customer service. We have deep integrations into the rest of the sort of modern fleet businesses operating stack, their telematics devices and GPS, and like their fleet management software, their human resources software, et cetera. The incumbents are built on this 30 or 40-year-old technology. They don't treat their customers all that well, as I mentioned earlier, and they enjoyed a moat because of the proprietary systems for decades, but now there's an ability for me to jump over that moat, and that's been very exciting for us. I'll say one more thing, which is that like with regards to sort of the theme of embedded fintech here, I think of Coast often as like something of a poster child for this thesis of like vertical SaaS plus payments because of the integration between sort of the core payments function and the software, and different companies approach it in different ways. Some companies kind of like lead with software. I think about Shopify. It started with sort of just an ability to sort of have a platform for listing your products for sale online, and then bring in the payments behind it naturally, because that's where the customers are already there and financial services makes perfect sense to offer. There are other companies like Coast which lead with the payments. And I look to sort of some folks who came before us, Toast is a very good example, the restaurant payment software, which sort of leads with the payments and then sort of brings the software to bear behind it over time because of how much the payments is an initial hook. And I think that like sort of the way that your organization sort of gets built and the specializations really depend on which direction you're coming from. And so we're leading with payments, but really building out a suite of software behind it as well.
Yeah, and what I'm hearing too is this sort of theme around in just serving, using modern technology to not only serve the customers better, but to serve a lot more that used to be unable to serve, right? Just because of a variety of reasons, including cost. And now I do want to talk a little bit, sort of switch gear and talk a little bit about growth, because as we know, the market right now isn't as pretty as it used to be, whether you're in lending or not, or whether you're in anything related to fintech. There's a little bit of that dark cloud over our head these days. And so I just thought maybe just to paint the color a little bit more, maybe just start with the kind of questions that investors are asking you more about nowadays and then previously, just to sort of set the stage a little bit. And what do you think are some of the reasons that that's happening, and how you've been handling those type of questions? Anyone?
I can start from the public market vantage point. I'm sure the others are going to have a much sort of more acute perspective on earlier stage and then sort of seed stage and mid stage investors. I'd say that if you sort of classify the proverbial sell the sizzle, not the steak kind of story that public companies, pre-IPO companies went to market with in sort of 2020, 2021, Flywire is no different in that there were sort of these massive TAMs that investors wanted to hear. They wanted to hear that companies had compounding growth stories for the next 15 to 20 years and could keep growing at whatever rate they could be. It's very much been a very quick sort of inversion into the back to the basics. So investors obviously want to know that there is a serviceable total addressable market that buys you 3 to 4 to 5 years of runway if you're in sort of a public company. They also have shorter term horizons, so they're not necessarily looking for massive TAMs anymore. A part of it now is also they're much more focused on sort of core elements of things that the market had forgotten about. Things like EBITDA, things like sort of unit economics. So from a company standpoint, being able to articulate how do you get profitable on what you're selling at an underlying level? From there, how do you get scale in the infrastructure that you've built? How do you get scale in sort of your go-to-market? How do you get scale and efficiencies based on channel partners if you choose to use channel partners? There is that sort of next layer of questions that companies like Flywire and others have been getting, which traditionally we hadn't been. And then it's also just more dissection on, you've talked about a $50 trillion TAM. What is truly serviceable for you now, and then what is sort of that path to get there? And investors have started asking the question as to what's the framework there, and what for different parts of the serviceable addressable market, what do the economics look like? Is it the same take rate? Is it the same go to market? So just a lot more scrutiny, both in terms of how you articulate growth and sort of how that growth is going to be funded and how sustainable it is.
Anyone else wants to share on this thing about environment itself and how investors have maybe sort of reacted differently, or how your conversation are changing since when you first started?
People were saying something about gross margins. Does anyone know what gross margins are? I never heard of them in 2021. Seriously, I mean, I think we saw a lot of businesses in 2021 and late 2020, like particularly in fintech, to Uday's point, raising a lot of money on high growth without putting much thought, frankly, into their unit economics. And this is a trap, I think, in businesses that have a credit or lending component, particularly, which both my companies have had. It's like quite easy actually to grow a lending business really fast. You're giving away money, right? That's actually not hard to sell. It's a lot harder to get people to pay you the money back. And companies that weren't thoughtful on risk and credit could quickly end up with negative margins due to heavy charge-off losses and the related high cost of capital that you need to pay when you have a book that loses money. So we've seen that with others in our space. I think in 2023, investors are spending a lot more time thinking about contribution margins as well as acquisition economics, and it's no longer okay to just grow at all costs. And it's frankly probably for the best. But you see people kind of sort of recovering from the hangover now a little bit. And again, I think that it's a frankly healthy shakeout.
And maybe it's good to sort of morph this discussion into, and I've certainly seen in some of the discussions where times like this, though, you will start thinking about that take rate and all the different pieces and where it all disappeared to. And as a result of that, it starts to kind of shape some of your roadmap, for instance, right? You may decide, for instance, something that you used to look to others to do, you decide to take upon yourself because you don't want to give as much of it away. So maybe, Khalid, I'd love to hear a little bit more about maybe, how has this shaped, and maybe just share a little bit of how you're growing more healthily with this recent recognition of back to the basics, and maybe get a little bit more specific on the how and what are some of the changes you made or you're planning to do.
Yeah, actually, we've recently dedicated significant attention to this area, right? Not due to churn concerns, but because we recognize the immense revenue potential within our own existing customer base. We grew fast on the customer side, and we are a SaaS business while we offer a SaaS product. But the primary focus is on our payment business, utilizing SaaS product as a land and expand, if you will, strategy to strengthen the relationship with customers, But then how can we utilize the GMV? Currently we provide a couple of products that are launched into the market where we enhance the booking and payment experience, but these products improve our effective take rate. So if you, David at Unit said, like they started in the bottom of the stack and the infrastructure and they're going up the stack. We did the opposite. We started with an interface, following the guest journey, right? The guest journey is you book, you pay, and then you stay at a hotel. And so we started with a booking interface and then started building product and features deeper within the stack. And so how can they come for the booking and stay for the payment? And features that we leverage to increase our sort of growth metrics, right? Obviously increasing the GMV. That's not only adding hotels, but servicing other channels other than direct, because Self-Book serves the hotel website directly, right? But how can we serve travel agents and other booking channels that are coming in that still have offline payments, right? There's a travel agent consortium in the US called Virtuoso. They have about 20,000 agents. They process $30 billion annually, all offline. That's when you give a credit card to a travel agent over the phone or someone takes a picture of it. And so those are the sort of things, how can we expand into that GMV and then increase our effective take rate? And so by offering other services like flexible cancellation for users or privacy, payment privacy, because right now, you go to a hotel, you still have to give your credit card, you put a hold on that card, and even though you booked and you paid online, there's still a manual transaction heavy process when you arrive to the hotel. So what are the features and products we launched to serve the guests? And then that effectively increases our take rate and obviously guest adoption for some of these services. So all along, we focus on this a lot, on utilizing our own current GMV. How can we add multiples to it? And then obviously at the same time, expand the TAM and expand the market.
I love this sort of the spirit. And for those of us who's gone through a couple of the down cycles, can all recognize and truly value the fact that some of the companies that are actually, growing and building nowadays will ultimately become a much healthier one, just because you are sort of just much more disciplined into thinking about what does it mean to be healthy and how do you create more values in different ways. And you touched on something that's, again, sort of familiar. And at the time when it happened, we didn't know. And that's what we call like a channel partnership, right? In many ways, if you think about a firm as well, I often tell people, yes, there's a something that's been around for a long time, but something we also did was cheat the CAC a bit, right? The CAC itself, the customer acquisition cost, could really, really rob you of your success. And so I just thought I sort of maybe open up a little bit to see if any of you have any other sort of growth strategies and the likes where you found most cost effective, anything that you've done beyond what we just heard so far that you'd like to share? Because this is an important thing for us to all take notes on.
I'm going to, I'll jump in here, and I think Khalid just sort of described it about it as well as I could have. But again, similar playbook in that, similar to sort of what Khalid is doing. We've got, as a business, we've got two sides of a network. We have, for simplicity's sake, we've got international students that pay with Flywire, but we have universities that we sell to that enable Flywire as the payment method. So our intrinsic cost advantage is that we don't actually have any consumer marketing that we're doing. We're solely selling to the university that then uses our product. Now, the question ultimately is how do we sort of deepen that relationship with the client, knowing that we can extend sort of the lifetime value and just through that intrinsic advantage that we have the relationship. So there's a cheaper acquisition cost. So we did something quite similar to what Khalid did, which is to say, if you think about the university, they have certain amounts of their volume coming from international students. They also have 70% of their total volume coming from domestic payments. They have payments coming from 529 providers. They have payments coming from charities. They have payments coming from grants and so on. So what we've basically done is take the view that we've got this captive audience. What are the other flows that we could build sort of in rank order of level of investment and level of sort of benefit? And we've taken a very sort of deliberate and staged approach, knowing that if we enable more payment flows, and if on the product and technology side, we're integrating more deeply with the university, we're just going to be stickier and harder to sort of displace. The one other component to it is we get payers for free. Basically, we don't spend that much on consumer marketing, which is an intrinsic advantage for us, because now if we've got the other side of the network, we can get into super interesting things like enabling living expenses or enabling international students to get loans, and the list goes on and on and on about sort of the opportunities. And again, tying this back to what investors want to hear and what they want to see. You have to be staged about it. You can't sort of sell the entire vision all day one. But again, aging and staging all these investments to drive sort of better unit economics are the things that investors sort of like and are sort of attracted to. But it's very much part of the strategy that we have.
No, and what you just now started uncovering too is sort of the part that isn't so commoditized, this customer obsession and familiarity, and really continue to add value, because everybody's sort of going through the same thing. How do you do more for less, or just make sure that it becomes stickier over time? But to do that, it does inherently mean that leaning maybe to the like of Unit to do some of the more core part of all that, to make all that stuff come together. So I wanted to sort of maybe turn it back to David a little bit more, just to kind of hear about keeping up with the growth, right? How have you seen sort of the customers' demand growing over time, particularly in your sort of, we've heard from Khalid and Uday about how they're evolving. Love to hear a bit more about from the infra standpoint. What are some of the features that you on your roadmap and that is still missing that we should look forward to?
Yeah, so I think when we think about kind of the potential for fintech and embedded finance, you can kind of think of it on a spectrum between pure fintech and pure software, and embedded finance is somewhere in the middle. And I think what we've seen over the last couple of years is that being too close to being pure fintech is a really difficult place to be from a growth and cap perspective. There's this classic idea that when you bring in a new product market against existing competitors, there's a question of, can you get distribution faster than your kind of incumbent competitors can kind of copy your innovation? And I think in the early stages of fintech, we actually saw that the existing incumbents were able to, build mediocre software faster than a lot of kind of the first generation of fintech companies could really get that growth. And so I think what we're seeing now in terms of the really successful fintech companies are those that are doing a much better job of actually marrying those core financial services with new software experiences that makes them compete not directly head on with the incumbents, but makes them offer a different product, bring in a new product market. So when we think about, who are our most successful companies and how can we make customers and how can we make them more successful, it's really about building those integrations with new software experiences, as opposed to saying, oh, you're going to, build a credit card and take that credit card to market against Capital One. And the closer you are to being a pure credit card company, the harder that is. The more that you are a software company that happens to have a credit card, the better. And as other people have said, the way that you start that journey might be different. You might start with a credit card and layer on more and more software experiences, or you might start with a software experience and layer on more and more financial services. But I think the trap that we've seen is people say, oh, there are these big legacy incumbents, and if I just do a purely digital version of what they've done, I can somehow outcompete them. And I think that's been less successful than saying, actually, the ability to embed financial services into software allows me to create new products where not only are my products differentiated, but then my distribution can be differentiated, my growth strategy can be differentiated. And those are what we see being kind of most successful.
Excellent. And maybe now let's get to a little bit more specific, and just to see if any of you have what are some of the verticals where you still see white space for embedded financial products? I'm curious. Obviously we have someone who's tackling the fleet. Maybe I need to be inspired, because that could be my next thing to go and build. Jensen,
it'll be an honor to be with you again here. No, I would say, listen, I mean, obviously, the sort of the lens through which I view the world has facilitated a certain myopia, but I just think fleet. I mean, when you look at sort of this market, I mean, it's pretty staggering. And this, by the way, is just wherever you look in financial services, it's just stunning to see how big markets are. You've got $120 billion being processed on these very specific fleet fuel commercial charge cards in the US every year. It's more than 10% of US B2B card spend. Who thinks about that, right? And so for me, I look at that as the tip of the iceberg, because I look at our customers and they have complex financial lives. I mean, they care about operating capital, like receivables factoring is a big thing in their business, but there's other financial services needs you can think about. Driver payroll, maybe there's even a B2B2C store. You sell consumer banking services and earned wage access. These millions of commercial drivers that probably, some of the sort of purely just digital consumer folks, Chime or Current, would have a hard time reaching directly. But if they're already holding a Coast card from their employer, like what can you do with that? There's other categories of commercial spend, roadside lodging, QSR, business banking, insurance, maybe even vehicle leasing and financing. For us, we look at it and say, like, with our vertical specific approach, because there's a very sort of specialized, vertical specific, tailor-made solution of the fleet payments card end up being a wedge to build that more holistic financial services platform for the industry, to the point that Uday was making about sort of increasing stickiness, increasing revenue per customer, making the acquisition economics and payback start to become incredibly attractive. Like, I think that that's a formula in our business, which I see as just absolutely vast for success here. And I'm sure there are analogs throughout other verticals, but again, I'm speaking what I know.
Absolutely. Anyone else dreaming of something else where we can go and tackle and make it better before I move on to the next question? No? Okay. Well, love to just to sort of hear a bit more about, obviously the financial institutions are taking notice. And obviously just, even the regulator at times would scratch their head on how do you actually, think about who to regulate, how do you actually evolve even the way we go about regulating. Just wanting to hear a bit more about, things that you've seen in terms of actions or trends that may be happening as a result of more and more of embedded fintech growing.
Yeah, so as I mentioned at the beginning, Unit, we really serve two different customer bases. One is software companies that are looking to embed financial services, and the other are banks who are looking to grow their business via fintech channels. And I think it's important to step back and think about the landscape of financial institutions in the United States. We're actually a very bizarre country because of just our history of interstate banking laws, where 30 years ago we had 20,000 different banking companies. While there's been some consolidation, we still have 5,000 banking companies out there, and you can probably name 10 or 15 off the top of your head, which means that there's just this massive long tail that were historically had kind of these geographic monopolies or oligopolies, where they really owned a community that was based on geography. And as more and more of our lives move to the digital realm, obviously those kind of geographic competitive moats are starting to wane. And so I think it is a really interesting time for these banks, and many of them are choosing to kind of say, okay, rather than moving from kind of these geographic specializations, how can I move into more a digital first specialization? But I think there's a couple things to say. One is it's a very different way of running a business. And so just because your organization was good at running a physical branch-based bank, you need a very different set of competencies, and especially if you're going to market through channel partners. So you're not going to market via people who are sitting in your branch who you can oversee. Now you're overseeing digital marketing, social media marketing, the internal activities. And so that's a lot of what Unit provides is how do we provide that oversight? Because there's really a number of parties here. Not only does the bank need to oversee all of the activities that are going on via its partners, but really what's important is that the regulators have visibility and confidence there. And so it's really how do you give the regulator confidence that the way that a fast-growing technology company is marketing itself on social media meets kind of the letter and the spirit of the banking regulations. And so you see a lot of investment there in terms of how do we create that visibility. And I think visibility is such an important piece here. But it's definitely I think going to be challenging for a lot of financial institutions. And I think there's a real question of in a more digitally forward world, do we need 5,000 banks? And what happens as we go from 5,000 to likely a smaller number in the next decade? And how do those successful companies make that transition from owning and operating a physical location to really investing in visibility and oversight across this much more distributed digital landscape? And it'll definitely be an interesting next couple of years on that front.
Yeah, but for sure, I think fintech will play a role in helping, right, in sort of partnering with some of those existing, and then we're seeing some of those cases already, right? Some of the sort of lesser known bank or community bank and likes are actually clearly partnering up with, I mean, for instance, with SVB recently, it really was a bit shocked to me to find out, wasn't a shock to know that majority went to JP Morgan Chase, but Mercury and Bricks were up there at the very top. And of course, behind that, there is some other bank, and just to kind of see how that type of partnership will also grow. And inevitably, I do agree with you, David, that I think there's definitely going to be some changes there, but nevertheless, I think fintech will serve a big part of that. So with that, we can chat, and I almost wanted to go right into banking as a service, but that's not the topic of today. What I do want to do is actually ask everybody, as a bit of closing this out, I'm sure the audience, there are some folks that are aspiring, and perhaps I'm being one of them, of becoming a fintech founder. And so I wanted to turn it over to you to see if any of you have advice. Actually, all of you, I want you to at least give one piece of advice for someone who is dreaming about that. What will you offer them?
As a non-founder, I'm going to go first, just because I think the history of Flywire serves as sort of a bit of an interesting case study. So Flywire, we started in 2010 being absolutely laser focused on serving the needs of international students to pay their tuition. And two things basically happened. One is we were told we were a very niche business. And then the second is reflecting on sort of that, we tried to get into things like prepaid cards and so on for international students very early on. And turns out that's not a good business, and we nearly bankrupted our company. So if I were to summon sort of the early founders of Flywire, really the best thing you can do is be obsessive about finding product market fit early on. And there are going to be sort of always these compulsions to think bigger about the products you can serve and sort of the end markets you can go into. But as from the founder standpoint of starting a company, I think that sort of focus would have done us a lot better. And eventually we got there, but I think that's a lesson that I've learned.
I want to echo this point. Like I my advice to folks all the time is like find your niche market, which is actually a giant niche. Like you can't go after the whole like horizontal. At the time we talk about this a lot of coasts. Like you've got like $25 trillion of B2B payments in the US overall, like $1 trillion of that's on cards, and then there's $120 billion I talked about on fleet fuel payments. That's a hell of a niche. Like you tried to go after any of that other like 25 trillion directly, and like you'll just get blown up. But this is like the vent and the Death Star. It's like the weak point. Like you go after it, and then that allows you to blow up sort of the rest of the thing, if you allow me like a geeky reference. But like so I don't recommend that people say like, oh, mortgage is a huge market, I'm gonna go like reinvent that. Let's like, don't worry, in payments, like markets are all huge. So find your little huge one to call your own and sort of grow from there. The other couple pieces of advice that I give people usually is like, first of all, this is like my I guess like unpopular contrarianism. Like, don't try to reinvent credit underwriting. I was on a panel with Alec from a firm, and he was just like, "You're totally wrong about this, Daniel." But I'm like, I'm like, you know what? If like you're like doing prime stuff, you know, like FICO rank one is pretty well. That's pretty secret fintech. So you can have your magic machine learning model that beats the stock market or whatever. But like for me, like this is not the place to innovate. The place to innovate is just great payments and credit experiences for merchants, for consumers, for businesses. Like that's where like technology can really sort of provide leverage. And then finally, like to sort of the theme of Unit and sort of other infrastructure, just don't do it all yourself. Focus on sort of what makes your company really different and special, which again, for me is just creating those great experiences. Things about ledgering, payments, like the decisioning, et cetera, that we did all have to build ourselves in the past. Don't try to do it today if you don't have to. Like you can actually focus on what makes you unique, and that will sort of create sort of the real sort of equity value, the asset and the enterprise value in the market.
Maybe, yeah, one other way of thinking about this, it's actually kind of bizarre that we have a lot of financial services brands, because financial services at the end of the day are a means to an end as opposed to an end of itself. Nobody wants to make a payment. Nobody wants to take out a loan. These are all things that you do in service of some other experience. You get a mortgage because you want to buy a house. You take out a loan because you want to invest in your business. And so I think as we think about the future of this industry, it's really recognizing that financial services should be under the hood and that they're in service of some other customer experience. And the more you can lean into building a great customer experience for what that customer actually wants to solve, as opposed to building a slightly better financial product, I think the more success that you'll have.
Well said. Khalid, let's
Yeah. So in general, as founder, I think perseverance is key. And so perseverance meaning, you go through so many different pivots, so many different changes and iterations of your product. Your first idea is usually your ego. And if you hold too much to it, you probably will fail. And so you have to adapt and you have to read the room, if you will. And so we started Self-Book as actually a consumer app. And because we wanted to get people to discover and book hotels with a single click, right? And hotels couldn't provide a seamless booking and payment system. But then we discovered that in order for us to move payment or credit card from the app to a global distribution system with our property management systems was impossible. And so how can we deal with an Apple Pay requires a cryptogram, Sabre doesn't really know what that is. And so those are simple examples. Or for instance, you have customer initiated transactions and merchant initiated transactions. You make a payment here, and then you have to go to the hotel and then reauthorize the card again and be present and sign. And so that's why we moved to B2B, because we figured, we can embed some financial services into the booking experience. And so you have to adapt and you have to continue to research and pivot. And we pivoted to what we are today, right? And so, I'll end it with, the British politician, Walter Elliott said, perseverance is not a long race. It is many short races, one after the other. And that, is relevant to this and being an entrepreneur.
well said. Well, thank you all so much for really this delightful and enlightening conversation. I wish to reach out to all of you individually to continue some of these discussions, and be careful because I just might do that. But really, I think it's a very exciting time, right? To in David's point about like in the service of, and to see how fintech can continue to be in the service of sort of critical experiences and continue to do that more. I'm sure it's going to continue to evolve and go on different places. And as I said, it's something that's close to me, where even this sort of first embeddedness that I ever encountered was something that the customers actually decided to take upon themselves to show us. I can't wait to see how fintech will continue to take commerce to new heights. So with that, it is nearly 11 p.m. my time. So we will wrap it up and I'll turn it over to Ria.
Well, thank you everyone for that engaging discussion on embedded finance. I can say on behalf of everyone listening that we learned a lot from your conversation. I'd say specifically as an aspiring growth investor in fintech, really enjoy the dialogue around your strategies around balancing CAC and LTV, as well as advice to find a giant niche. Definitely something to keep in mind as I try to find the next Coast or Self-Book. For everyone tuning in, we'll be moving into our next event on the Fireside Chat stream at 11 a.m. So see you all there. Thanks, everyone.
Thanks so much, everyone. Good night. Bye.
Thank you.
Hey,
Hi, how are you?
good, good. Happy Friday.
Yeah, happy Friday. Is that your real background?
Yeah, yeah,
Oh,
yeah.
it's cool. It's a very cool bookshelf. Looks like it could be a Zoom background.
Yeah, I'm just working from home today.
Hello,
Nice, me
I'm
too.
here.
Hey, Talika.
Hey,
Hello. Are you on the East Coast or the West Coast today?
We're both in New
East
York.
Coast. Yeah.
Oh, amazing. Harsha has joined us. So has Aditya.
Right? Hey,
Hello.
guys.
Hello.
Hey guys.
I guess we're waiting for Alex and then we should be good to go.
Okay, great. How's it been going so far?
Very well. We had an amazing in-person panel yesterday, and today, since like 8 in the morning, we've had a couple of amazing panels, couple of fireside chats. It's been going really well.
Good. Good to hear.
Yep.
Talika, is it a big turnout in person?
Well, yes, we had, I think, 70 to 80 folks in person in Philly, which is a big number.
Yeah. Nice.
Yeah.
Harsha, Aditya, where are you guys calling from?
I'm in New York.
Oh, nice.
I'm based in San Francisco, currently in Chicago, just for the weekend. Yeah, it's rainy slash maybe snowy. So yeah.
Nice.
Well, I'm assuming you're in New York.
Yeah, I'm in New York. Yeah.
And I am as well.
Oh, nice.
Yeah,
We've got a East Coast crowd here.
we do. Yeah. Yeah, Nadia, it's great to meet you. I know we haven't officially met yet, but I've heard lots of awesome things.
Same here, Addy.
And yeah, thank you all for bearing with my questions list and random assignments. Hopefully I did you all justice with the topics.
Really good topics. Yeah.
Although, you know, Tali and Alex, they helped.
Nice.
Bo, is that a real bookshelf behind you? It
I
looks
asked
real.
the same thing.
It looks very real somehow.
It is real. Yeah, it is. It is indeed real.
Hey, Alex.
Hey, how's it going?
Good. How are you?
Good. Sorry for being a minute late.
Good. Hey.
Okay.
All right, I guess we're ready to kick off. It is my great pleasure to introduce our remarkable panelists for today's discussion on fintech infrastructure, unlocking growth for the next generation of builders. I would like to extend a warm welcome to our esteemed panel stars who would be sharing their insights, experiences, and strategies for harnessing the power of fintech. We have with us Aditya Goel, co-founder of Sardine, Bo Zhang, CEO and co-founder of Flithic, Harsha Dante, head of Stripe Capital at Stripe, Alex Dew, founding team member at Column. And finally, we have with us Addy Lerner, the founder and managing partner of Avid Ventures, who will be orchestrating the conversation as our moderator. Over to you, Addy.
Thank you, Talika, and great to be here. Thanks so much for having all of us on today's panel. So we have a really awesome lineup of panelists, some of the true innovators of financial infrastructure in this generation of it. So we're lucky to be able to learn from them today. So maybe to kick off and give a little bit more context on who these founders and operators are, what their companies do, let's just go around and can you each please explain what does your company do and what were the frustrations and technological advancements that led you to start your company? And Harsha, please tell us about what led Stripe to start Stripe Capital in particular. So Bo, I'll kick it off to you first.
All right, awesome. So yeah, my name is Bo, one of the co-founders of Lithic, and we're basically a issuer processor for powering credit cards, debit cards, virtual, physical, commercial, consumer card products. So if you want to launch a card, we're a modern provider for that. And the genesis of our story is basically my co-founders and I started a consumer fintech company previously called privacy.com. And we built and scaled this product on a legacy third-party provider. And over time ended up having to build our own infrastructure. And fast forward a couple of years, realized that, hey, tons of other companies need this and kind of the broader world needs this. And so decided to kind of spin it out as a separate brand called Lithic. And the rest is the past 2-3 years is history.
Awesome. Let's go to our other New York City based panelist. Aditya, please tell us about Sardine.
Hey guys, I'm Aditya, one of the co-founders of Sardine. We're a risk, fraud, compliance, and payments infra company. Essentially, if you're a user coming in, we can help fintechs, merchants essentially understand the risk of the user at the time of onboarding, at the time of account linking, funding, so any fintech apps that you use, and then at login as well. Really, the frustration came from, I was heading payments and US expansion for Revolut, the European neobank, and then my co-founder was with me as well. He was heading fraud there, and then prior to that, he was head of fraud at Coinbase, and our third co-founder was leading fraud products at PayPal. And every time we were building and scaling these large fintech companies, we realized the biggest problem that we had was fraud. Like we would build all this cool payments infrastructure, but then as soon as we would launch a new product, it would become really hard to scale that product because almost 30% of the user base that would come in on first day would be fraudsters. And we would see people who would even pass their documentary KYC. So they would put their photo, their ID, and 90% of the fraudsters would even pass through that. So that was just like a shocking piece that we learned, like you really need, especially as the digital money is going faster, you need these infrastructure tooling. And it took us 2+ years at these companies, hundreds of millions of dollars. And we wanted to build something so that anyone that is focused on money movement can focus on actually their USP rather than having to build this infrastructure time and time again. So that's how Sardine came around.
Fantastic. Thank you. And Alex, over to you.
Yeah, hey, good morning, everyone. So Column, maybe most simply put, is a bank that enables non-bank companies to offer financial services products. So such as accounts, wallets, payments, card issuing, lending. So we play pretty deep in the stack and play behind the scenes for a lot of fintech companies that you all may have heard of. The example I like to give is in the US, if you want to hold, move, or lend money, typically you have to work with a banking partner for regulatory reasons. And so one of our customers, Brex, for example, is not a bank. You all may be familiar with Brex's services and products. So Brex is able to, acquire customers, provide great product to their customers behind the scenes to actually hold the money and move the money. It's Column. And so, people mentioned, I know Bo and Aditya mentioned frustrations they've had. I think they'll appreciate this, but the reason why, we all started Column was because unanimously for like the last decade, one of the most notoriously painful parts of fintech is building with banks and partnering with banks. And so for us, the answer was, hey, let's go attack the problem from the inside versus trying to solve it from the outside.
Super, super interesting. And we'll come back to a lot of questions around partnering with banks and banking partnerships shortly. And Harsha, tell us a little bit about Stripe Capital. I think probably most folks on this listening into this panel are familiar with Stripe, but tell us a little bit about specifically Stripe Capital, its purpose, how it came about.
Yeah, one of the very first things I worked on when I joined Stripe in 2017 was to explore the opportunity to provide financing to merchants. And the real reason that we decided to launch the business was actually based directly off of user feedback. We surveyed our merchant base in 2017 and asked them what was the biggest inhibitor to their ability to grow. And the number one answer that we got was access to financing. So after establishing the user need, we then spent a lot of time just trying to figure out if Stripe was able to provide a solution here that would be helpful. And similar to other payment processors that have offered lending services, we thought that some of the advantages we have with data, being the flow of funds, user relationships, would allow us to provide a real best-in-class product for merchants here. And so we launched in 2018, and I think the business has scaled nicely. And also, I think what's been really cool to watch happen is that it is the positive user feedback loop in terms of it's a very popular product with merchants, as well as we actually see merchants that take a loan from us grow faster than those that don't, in part because they're able to use those funds to help grow their business and manage their cash flows.
Awesome. Thank you for that. So as you can tell, we're talking to some of the leading fintech infrastructure founders and operators today. And we at Avid Ventures, which is a $150 million early stage fintech and software venture capital firm, love fintech infrastructure because we think we're just in the early innings of what is a massive transformational shift in financial services. And we back companies that partner with many of these providers and players here today. Full disclosure, we are not an investor in any of them. And one thing we think a lot about is, okay, well, how do you define fintech infrastructure, specifically within fintech? So maybe we can do a lightning round with our panelists. And if you guys can, in one, maybe two max sentences, tell us, how do you define fintech infrastructure? Alex, let's start with you.
Yeah, for me, it's all the behind the scenes data and processes that enable storage and movement of money.
Love it. Aditya?
Good question. I think there are a lot of ways, but at least the way I think about it is anything that that is not core to your USP, or essentially like that differentiates your product so much that you need to build it, everything else should be fintech infrastructure.
Bo, how would you define it?
I think about it as like the supply chain for, to Alex's point, moving money, storing money. And yeah, I think it's anything that's sort of at that level to deliver a financial services product is sort of part of the infrastructure world.
And Harsha?
Yeah, I think really similarly with maybe the nuance from the Stripe perspective is like offering a direct product to a merchant directly, but also like a platform for others to build their own infrastructure products on top of.
Yeah, I think you guys nailed it. And I think something Aditya brought up, which is really interesting, is this idea that companies, like a Lithic or like a Sardine, can focus on what they are best in class in, right? Which is issuing cards or doing KYC and fraud, so that new operators and companies can build and don't have to worry about starting from scratch. There are like best in class products out there that they can rely on. So let's talk a little bit about banking, which we started to chat about earlier. Banking and regional banks and bank partners have been the topic du jour over the last few weeks, as everyone on this call, and I'm sure a lot of folks listening, are quite aware. So would love to talk, especially to Alex, who's literally building a bank, about how you think the current banking crisis that's been sparked by SVB, Silvergate, Signature will impact both traditional financial institutions as well as fintechs in the near term and over the longer term. And how have you guys reacted to, in the immediate aftermath of the situation? How have you been supporting companies who can't rely on these three institutions specifically, but also just institutions who are rethinking their banking partnerships more broadly?
Yeah, I'll start by saying I'm still physically recovering from the last 2 to 3 weeks, which has just been maybe the most exciting and tiring time of my career. But I'll start with what it looked like at Column when SVB went down, and then kind of just high level thoughts on what that means for bank partnerships with fintechs going forward. So, at Column, we had a pretty unique lens. I'll give you a couple of examples. That morning, before any of the reporting came out, I was looking at our transaction activity in our internal tooling and was seeing some unusual activity. So a couple of examples, $250,000 wires. You very rarely see people send flat $250,000 wires. We saw a lot of those that morning. A sudden influx, from our support on same day account openings. Folks come in and be like, hey, I need to get an account open same day by 2 p.m. and I want to wire the money out. And this is, we have some inflows, day to day, but never at the level that we had that Thursday morning. And so very quickly, we looked at it and said, hey, these are all SVB related. And I'll be honest, initially I didn't believe what I was seeing. I said, hey, this is just a small blip, whatever, we'll be back to BAU tomorrow or, second half of the day. But by that afternoon, it seemed pretty obvious to everyone on our team, just looking at the data, that there was a bank run going on. And so what we ended up doing is we reprioritized our entire company across 3 vectors. So the first one is protecting SVB customer deposits. So that means, getting as many accounts open as possible for SVB customers coming in who said, hey, I'm trying to get my deposits out. Protecting SVB customer operations. And so, a lot of SVB customers have payment processing as part of their business, ACH processing. That might be collecting loan repayments via ACH debit. That could be collecting software SaaS fees via ACH debit, or making payroll, paying vendors, critical vendors. And so for us, it was getting them set up as quickly as possible on our payment system so that come around Monday, right, they can still make all those payments. And we did that for, a couple dozen of SVB's customers. And then the last vector is, we had our existing partners who saw their volume go from BAU to 10x all of a sudden in the day. And that created some service need on the engineering side, business side. And so, our team supported there. I pulled a couple high level numbers just because I was curious for this conversation. We ended up opening up a couple hundred bank accounts directly that day for SVB customers, took on a couple $100 million deposits directly onto our balance sheet, and then indirectly facilitated a couple $1 billion of deposits coming out of SVB through our payments network. Within that 1 week period immediately after, we processed about $8 billion of transactions about the week after, after that crisis. So that's kind of what we saw through the SVB crisis, what we did. And then in terms of long-term implications, I think the obvious statement here is that banks working with fintech companies are going to get looked at a little bit harder than before. I think that's super straightforward. Boards and management teams of these companies, are going to be a lot more focused on bank partners. I'm already starting to see that with requests that, hey, can we talk about your bank's financials? Can we talk about your risk management practices? Which I totally get. I think that makes perfect sense. And so together, ultimately that means probably a little bit more friction in the industry. But when I look at the last 2 years of how this industry has developed, I think there's been a huge push between banks and fintechs to race towards, hey, who can get the loosest on requirements? How cheap can we get a program to be? How lightweight can oversight be? How much can get abstracted from the bank? Which I've always thought that's long-term negative. That's a very good short-term thinking to launch products faster, long-term negative for the industry. And so, something that we've encountered over the last 2 years as a bank partner is we've walked away from a lot of deals because of this push towards this direction that we didn't like. And, so from my perspective, I welcome the reset that's coming, which I think ultimately is going to benefit the banks, like ourselves, and then the fintechs, like the Lithics, like the Stripes, like the Sardines, who play the game the right way and have always practiced safety and soundness. And I think long-term, that gives us the competitive advantage back again.
Really fascinating perspective. And maybe, Aditya, talking to you about from an operating perspective and knowing that you're serving a lot of customers who probably banked with or worked with these banks, you might even have partner relationships with them or with other banks. Curious to get your take on this one, the current banking crisis and fallout from what happened over the last few weeks.
Yeah, I think definitely been no shortage of drama over the last few weeks, as we have all seen. I think to actually pick on Alex's point, right? The last few points around, we've been already seeing this, but especially if you look at all the three banks that you mentioned, right? They banked heavily with fintechs and crypto companies as well, and that has actually left a big gap in terms of the financial institutions that are willing to serve, especially crypto, but even I would say more and more fintech companies. And what we've seen is more and more the focus on the soundness of not only, of course, the financial strength of the institution, but also the compliance program. What are the oversight practices? When today a fintech works with a bank partner, it becomes really hard for a bank partner to have full real-time understanding of what's going on under that fintech on a day-to-day basis. Of course, they can get back the data, but it becomes really hard to actually analyze that data, understand the risk on a very granular level. And that's kind of where we are seeing, because we work with a lot of clients that have various different bank partners, and a lot of them, and we also work with a lot of bank partners directly, BaaS providers, and more, there's that level of soundness that is required from an oversight, because at the end of the day, these banks are lending their charter to these fintechs, and they are at risk from the OCC and other regulated institutions. So where we are seeing a lot of the need is having this level of soundness, but real-time data, understanding the portfolio view of what is the risk of each underlying customer that these fintechs are onboarding. Are they compliant? What kind of practices? What kind of fraud? And that's kind of where Sardine has been helping both the fintechs as well as the bank partners. And I think that's where like a lot of the customers that we have today, but a lot of the new customers that came in the last, I would say 3 weeks, have come in because when we build out this very deep level of due diligence in a more automated way, more and more bank partners feel comfortable with that oversight, and that leads to a much less friction, especially in a market environment like this, for fintech to be onboarded. And I think one thing to add where we are seeing a lot more demand is just, again, we are also building out a real-time payments API on top of our bank partners, focused on, again, these fintechs as well as crypto companies, because a lot of times these crypto companies have the right pieces, but they just need that level of due diligence, which works with their bank partners at the end of the day.
Yep. Yeah, that's really interesting perspective. And as we think about the underlying banking relationships that exist for so many of these companies, that level of scrutiny is going to be even more acute from all parties involved, from the companies that are working with those bank partners, from their investors and potential investors, from regulators, and beyond. So, Harsha, I'm curious how you guys in Stripe Capital are thinking about managing either direct partner banking relationships or the banking relationships of the companies you're working with and lending to, and how do you underwrite those parties? How do you think that's going to change in this environment?
Yeah, I think that, across all the products that Stripe offers, a lot of what we are trying to do is take on a lot of the complexity of providing financial services away from our users. So like, behind the scenes, all that complexity still exists. And I think we view it as like, our responsibility to work with the partners that underpin that to make sure that we're taking away that complexity from the merchants themselves. I think that, there's how we manage this. I think like the simplest answer to that is just we invest a lot. I think that we work closely with the bank partners on everything from compliance, risk, reporting, marketing, disputes, contracts, et cetera. We build our technical products really hand in hand with partners to make sure that everything is kind of working as expected and compliantly. In addition, we have large internal teams that maintain our own licenses when we're subject to regulation directly, as well as kind of span lots of experience with the industry and everything from legal, compliance, and regulatory as well. I think to what we look for in bank partners, I think like we think a lot about like the ability to support the user's needs and a range of user needs, along with like product and compliance standards, regulatory experience, and technological capabilities. And then after we are like selecting a partner, I think we then think a lot about how to like maintain that relationship. So the right frameworks, the right joint frameworks that are two ways in the sense of like, we're able to kind of get a sense of what our partner's doing, and reciprocally that they're able to provide ongoing assessments of what's happening with Stripe. And so I think in summary, I'd say it's always been an area that we have focused a lot on, making sure we have the right partners, making sure we're managing those relationships well and growing together. And I think that's just all the more important in the environment today.
Yep, makes a lot of sense. Thank you for that perspective. So one thing, a couple of you brought up or alluded to is the fraud elements that are so important as we do think about banking relationships and fintech infrastructure more broadly. And a lot of your companies touch on fraud as part of the core product. Sardine is focused almost exclusively today on fraud and everything they do. Would love to hear, Bo, from you about how you all think about the biggest near-term challenges regarding fraud in fintech, broadly speaking, in fintech infrastructure, and specifically how Lithic addresses those concerns as part of your core product offering.
So I think from our vantage point, one of the really, awesome trends that we've seen over the past, decade is online account opening, and like that's like here to stay. I think a problem that is still like somewhat unresolved is like identity verification. Like we have a lot of kind of check the box policies that folks are doing across the industry, but I think like actually getting at the crux of that problem and like making sure that the person opening the account is who they are is still like a really tough problem. We don't offer sort of KYC ourselves. We're not in that space, but we do work with a bunch of companies in the space around that. I think where we tend to help out with fraud is around like ensuring that, hey, like if someone does get on board, minimizing the damage to the customer, maybe that be the fintech company or the end customer, and like kind of helping with that aspect of remediation.
Yeah, that it makes a lot of sense, and I think that's where fraud-specific providers like a Sardine can be quite helpful. I'd be remiss if I also didn't mention Alloy as a great KYC and fraud provider. We are investors in Alloy. So, would love to hear, Aditya, from your perspective, given you guys are so focused on helping to prevent fraud as you do identity verification, as you do KYC for a range of companies within the fintech world. What are you most focused on in terms of fraud challenges going forward?
Yeah, I think one thing to note is, especially in a market environment like last, I would say 1 year, fraud increases because there are various factors, right? One, the people who buy, like there is a concept of a liar buyer fraud. People actually buy something, but then they would go in to their bank and say that I did not buy this. And if folks are familiar with the Regulation E, which allows customers to go in and file that complaint with their bank, I think it's over 60 days. So that's a long-term window. And a lot of that happens, especially in markets like crypto and fintech, where you're investing and you lose a certain amount of money. But then the way we look at fraud is really a very holistic way. What are the various points of entry that fraud can happen at? One is, of course, the account opening, as Bo mentioned. That's where you want to ideally limit as much fraud as possible, like prevent folks from entering. There's something we saw again at Revolut, and we see this with a lot of our customers before they come to us. Over 90% of the fraud still passes through despite a documentary KYC and a selfie of the user. And primarily the reason for that is the second type of fraud, which is where you actually lose money, is when users are linking a bank account or a card through which they load funds in the ecosystem and then actually spend those funds. And a lot of time, those payment methods could be stolen. Those payment methods could be, in terms of one of the other ways we see fraud is account to account. So the movement of money has become faster. I'm sure you guys have seen Zelle fraud happen a lot. And as movement of money is becoming faster, scams have become a lot more prevalent. So this is one actually very, very interesting thing that we find for a lot of our fintechs. There's this behavior because we look at intricate behavior of how users are interacting with the app. And that's where it's very hard to fraud. Like, for example, if a user is buying something and then they're on the phone at the same time while they're, let's say, loading funds in, what we see is generally they're being guided by a scamster who's acting as a officer from a bank or a customer support agent. So if we combine those two signals, we're able to see that, okay, this is potentially a fraudster. And at that point, you can tell your partner bank or fintech, like what level of multi-step authentication they want to do. So overall, what we're seeing is it's very, very hard to pinpoint fraud with just one signal. And especially as the money movement's becoming much faster, especially with crypto, you need a real-time assessment at various checkpoints. And that's kind of like how we look at it. And I think one last thing to add would be, again, with, of course, ChatGPT and the LLMs that are coming in, it's going to become even harder to detect fraud, especially on the identity side. So that's where you need more and more signals that are not just based on identity, but based on a real-time, long-term, continuous usage of the user. That's kind of where I would say the Achilles heel of fraudsters live, and having that benefit would be a lot more helpful.
Well, I'm impressed we made it 30 minutes into this panel before ChatGPT came up. Although you're totally right on the ability for ChatGPT and AI to make fraud a much scarier and harder to detect element of access to financial services, and thus a real challenge for all the infrastructure providers. I'm not sure if you guys heard about or read about the story of the ChatGPT that was able to figure out how to solve a CAPTCHA, like to verify a human CAPTCHA, by actually figuring out that they could go hire a TaskRabbit to actually fill it out for them. So like that's pretty creepy that that ChatGPT is getting that creative, and it does open and pave the way for AI to outsmart more traditional fraud restrictions and policies. We'd probably also be remiss to have a conversation about fintech infrastructure without talking about crypto and the blockchain. And one way that I think that you all are serving that part of the industry, which is a really important part of the future of financial infrastructure, at least in my opinion, is helping to do fraud and KYC for crypto-focused customers. How has your focus on that customer end segment changed or evolved given the current crypto winter? How do you think about the product and services that you offer these customers, specifically within the world of crypto and blockchain, versus your more traditional or maybe finance 1.0 fintech customers?
Yeah, so I mean, for us, at the end of the day, fraud, the fraud vectors are largely similar, and we look at fraud as a broader industry. We started with crypto because that's like a lot of the space that we were in, and also I would say the smartest fraudsters are generally in the crypto space because the velocity of money is much faster. Once crypto is gone, it's gone. We actually like to call it, if you grew up in a bad neighborhood, you learn a trick or two. So a lot of the elements of fraud that we've seen in crypto, we actually not only serve crypto customers, I would say one third to less of our customers are crypto customers. Rest are in fintech, large financial institutions, brands, digital ticketing companies. Even we see similar patterns of fraud in cannabis, in NFTs, in digital markets, in gambling. So it's really interesting that the higher the velocity of money, the higher the amount of fraud ends up being. Specific to, I would say, how we are looking at adding more and more guardrails. I think this is a key thing for pretty much that has come up with every financial institution. I mean, we do believe crypto is here to stay. It's not going anywhere. It goes through its winters and summers, but it's really the world of how do you combine fiat and crypto and really that on and off chain world. And one of the reasons a lot of the financial institutions today are not comfortable is because once it goes on chain, they lose that track of where the money is going. So building that one layer that can allow them that level of transparency, but for the on-ramp as well as the off-ramp side. So if a user is doing the same actions in the fiat world, and then once they go on chain, how many hops on chain, like they send from one wallet to another wallet to another wallet, like how many hops has this transaction been through? Has it been through a scammed wallet? Has it been through a sanctioned wallet? Combining those signals into one simple API allows us to do that. And more and more, we're taking those pieces and really expanding the pie where you can plug and play at whatever level you want, at whatever checkpoint you want.
It's really, really, really interesting and a pretty essential, I would say, infrastructure approach to that piece of the market. Switching gears a bit, let's talk about international development of fintech infrastructure. While fintech infrastructure is less developed in a lot of countries outside the US, payments in particular is actually leapfrogged more traditional credit and debit rails that the US is quite reliant on. So curious how you all have been thinking about opportunities to expand internationally or not, given this dynamic, but then also given the challenges of operating across multiple jurisdictions with varying regulations. Bo, let's start with you. How does Lithic think about serving customers beyond just the US?
Yeah, I think one thing over the past couple of years that's been really common is companies talking about doing international expansion like much earlier in their life cycle than maybe what's like kind of prudent. And I think if you talk to founders or execs that have done it, almost everyone is like, hey, like we should have waited like a couple of years. It was like way more expensive. It was way harder. Like we didn't have the right local talent. Just like super, super expensive and tough. And so in general, we've been pretty focused on just the US markets. I think if we were to do it, it would be sort of in partnership with like one of our existing customers, because we still do get customer demand, you know, for international products. But in general, I am in the camp that it's something that comes like later in the life cycle of a company.
Yeah, I think that makes a lot of sense. It's hard enough to get fintech infrastructure like correct in just one market, given the regulation and also the perfect product and experience you want to deliver. Alex, I have a feeling I know the answer to this question, but you know, when you're building a bank, which is a very difficult undertaking and hard enough to do in one country, let alone in the US, how do you all think about your international strategy? I mean, is the ambition for Column to be a global bank one day, like an HSBC? And maybe in the meantime, how do you actually serve your customers who do have banking needs more globally than just in the US?
Yeah, you know, I think Column will probably be the largest bank in the world one day. So at some point, you know, probably will have to go international. But you know, more seriously on what Bo said, everything that Bo said is 100% true. I've heard that from founders as well. And then you can multiply that by a factor of 1,000 when it's a bank. And, you know, looking into entering a new regulated jurisdiction, new regulators, different country. So applying the two sets of rules versus one set of rules. But international, you know, is definitely a big push that we're seeing right now from a lot of fintechs who are looking to facilitate payments abroad for, you know, anything from remittances to payroll. You know, that's what we see a lot of actually is international payroll is a huge market that's being built out. And so our exposure international right now is, you know, we help US based customers send money abroad and receive money from abroad, primarily via the SWIFT network. And so that's right, international transactions, that's opening. We also open accounts for international entities in the US. And so when we think about international, for us, it's all about serving international, but outside, within the US. We're not in the, hey, I want to send money from the EU to the UK. We can't facilitate that. But if the US is involved and the US banking system is involved, that's where we focus on playing.
Yeah, makes a lot of sense. So I want to make sure we leave some time to focus on the investment element of fintech infrastructure, because I think we probably have some current or aspiring investors listening in today. So, maybe just to start with, for those of you who've taken venture capital dollars and worked with VC investors, what do you look for in VC partners? What attributes or experiences do you think make for the best and most value add fintech infrastructure investors that you've worked with? Bo, maybe you can start on this one.
Yeah, for sure. It's honestly, I was thinking a lot about this. And it's one thing really, it's patience. Fintech infrastructure takes a really long time to build. You can't move fast and break things. And a lot of times you're talking about kind of multi-year investments, and sort of big upfront costs that just take a long time to pay back. And I think having that patience is really critical.
Aditya, how about you and the investors that you all have worked with at Sardine?
Yeah, I think to echo Bo's point, that's really, really important because at the end of the day, these bets do take time, kind of similar to if you take in, right, like cloud, AWS started building it back in 2005, 6. Most of the street didn't even pick it up up until 6 years. And then by that time, of course, it had become big. I think to add to that, really folks who are more sector specific as well. I think that helps a lot too, because then you have a very deep understanding when you're actually thinking about building a new product or even going out and pitching to a specific client. I think there's a lot of valuable, deeper discussion that you can have with your investors. And I think the final thing would, of course, be reach. Like at the end of the day, we're a B2B firm, having access to, especially when you're thinking about early stage companies, at the end of the day, you live and die by your clients. Having the ability to be able to go into a room, having that right access, I think that makes a ton of difference at a seed or a Series A stage when your name is not that well known.
It's really, really good feedback and I think really helpful advice for those thinking about being or becoming fintech infrastructure investors. So maybe just to start to close out here, I know that at least a few, if not all of you, are not only founders and operators, but also angel investors. Would love to hear from each of you on what do you think are the most interesting early stage fintech infrastructure sectors and companies to invest in right now? Harsha, let's start with you.
Yeah, I'm very definitely not a prolific angel investor by any means, but I think the things that are to me very interesting to look at with respect to fintech right now are probably one, I continue to think vertical SaaS that have fintech models built on top of it continues to be an interesting application, especially when there's just a real customer value proposition being solved by the software in and of itself. I think another area that I find really interesting is FinOps, financial management tools for the finance suite. I think that is an area that it's just increasingly complex to run a business these days, with cash flow management becoming more important, FX hedging, visibility, budgeting, planning. I've looked at some really cool companies in that space that are trying to just make that easier for financial professionals, as well as just add insights and things to improve efficiency. And then I think the other thing that has been interesting to me that I'd say I'm a little bit early in thinking about is fintech applications to some industries that are being relatively rapidly innovating, healthcare, climate, things like that, where there are applications to put fintech on top of things that are bringing real value to a new industry there as well.
Yeah, absolutely. And that's vertical SaaS plus payments or plus some element of fintech is something we think is fascinating at Avid, because you can work with companies like a Lithic or like a Sardine in order to do card issuing, to do your KYC, to help with payments. You don't have to build that from scratch, and that can really unlock massive opportunities in these verticals, some of which are not so niche, right? Like healthcare, pretty massive. Yeah. Awesome. Alex, how about you?
Yeah, we talked about international, and we spent the last year building out the infrastructure for cross-border payments. And honestly, we're just scratching the surface. And I'll say, the more I dig into that whole space, the more I realize how much opportunity there is in building out cross-border payments infrastructure. And so, a couple of areas I've seen, right? Like I look at certain FX pairs are super expensive, especially out of the G20. Huge opportunity to bring down costs there by building out, by currency rails, debiting outside the US. So in the US, we're all familiar with ACH debits, getting money pulled out of your bank account. That's how utilities companies work, right? That's how telco companies work. That's not very prevalent in international markets. So you'll see a little bit of that coming up in SEPA, maybe in faster payments, but broadly speaking, debiting is not a concept that folks are familiar with. Those international payment systems are starting to launch that. And so there's super interesting opportunity to do cross-border debiting that hasn't really been built out at all yet. More straightforward multi-currency account capabilities on the card issue side and put for all these folks to want to do international settlement and local currency. On the treasury side, Harsha mentioned treasury management. So if I think about like cross-currency liquidity management for these multinationals, right now that's at the enterprise level. They have huge treasury teams that do it. How about a startup that has multinational presence? I think about a company like Jeeves. They probably have one of the hardest treasury management problems of any startup, given how many currencies they have to manage. So that whole ecosystem is super underbuilt, and there's just a tremendous amount of opportunity there. Unfortunately, not a lot of people understand it because folks don't really spend time in it. But I think as more people try to attack it and there's more need, there's going to be a ton of opportunity. And I'll shout out to the Wise, Neums, and Airwallex. I think those guys have done a great job getting started innovating in the space, but there's still just a massive opportunity that's untapped.
Absolutely agreed. It is kind of mind-boggling when you think about everything that has to happen to send an international payment across any form these days, and how much of a ways we have to go to make that super seamless and instant and fraud-free. Bo, how about you? Where are you focused? Where are you angel investing these days, or where would you be angel investing?
Yeah, I think a lot of really interesting areas. Probably what's near and dear to me is I think over the past couple of years, you've seen a lot of scale fintech companies get built, and like as part of that, a lot of folks have like seen like internal tool pains, and like kind of I'm really excited by like smart folks at some of these scale fintech companies going out and building like tools that solve like these like internal needs that they've identified, and that could be like fraud risk, like Sardine. It could be like workflow improvements around like chargebacks, disputes, and others. So that's a really interesting category to me. I think in general, I also have a soft spot for companies. I know Column hasn't raised any money, but companies in general that are building directly to the metal and kind of just going straight for like kind of solving the hard problem versus kind of bundling together or reselling. I think we've seen like a bunch of companies that are kind of bundles or resellers. And there's nothing wrong with that per se, but I really do just kind of appreciate like companies that just like kind of go and solve the hard problem. And I think the last point, Harsha, to kind of echo, like vertical software embedded fintech is like super, super interesting. I think we're in like this early innings here where you're going to see like much more like personalized and like niche use cases that get solved really, really well because you're able to embed payments into like a software product.
Hey, but there's a price for everything, so just let me know.
All right, we'll let you guys hash that out off the panel. All right, Aditya, please take us home. What are you focused on? Where do you think there are amazing opportunities for early builders in fintech infrastructure?
I would say actually Alex hit it totally on point. This was kind of our biggest takeaway at Revolut. We we had built out a pretty good infrastructure in Europe, but as soon as we even entered US, it took us 2 years to build out all of that. Then we spent another year building pieces for LATAM. And again, when I left, it was still not nearly done. So I started my early career at PIMCO, a large asset manager, and I think this was something that I always think about more as a framework rather than, I would say, a specific sector. But PIMCO caters to large institutions managing their pensions, and then when you look at something like today ETFs, right? You can largely replace a lot of that strategy for the smaller folks, and I think taking that away, that treasury management, especially cross-currency, cross-border, is really served only for very large institutions today by the HSBC cities and the JPMs of the world. It's such a big pain point for small to mid-tier companies, and that includes a lot of tech startups. It's a hard problem to solve. Probably takes a few years because you do have to go direct to the rail in each major geography you want to target. I think, that probably would be the sector that I would focus most on.
Some great ideas here, and I've been taking notes and for our avid roadmaps going forward. But I think that is a great way to finish. Clearly, so much opportunity within fintech infrastructure, internationally, in the US, across different types of payments, different types of identity and fraud, a lot of exciting avenues for folks to build in. So I'll close out here just by thanking our panelists. Thank you, Harsha. Thank you, Bo, Aditya, and Alex. And I'll turn it back over now to Talika.
Thank you so much, Adi. On behalf of Wharton Fintech, I'd like to take a moment to express our gratitude to our esteemed panelists for sharing their valuable insights and expertise with us today. Your insights on the wide range of topics that we covered, from banking to fraud to international opportunities, have significantly enhanced our understanding of the crucial topic. And we really, really appreciate your dedication to the event. Thank you so much.
Thank you.
Thank you all.
Thanks for having us.
Hey everyone.
Hello, how are you?
I'm doing
Conrad?
well. How's everybody doing?
Doing well. Is the sound coming through okay?
Yeah, I hear you well. So Carlos, once we have everyone in here, I'll kind of kick things off and then hand it over to you.
Sweet. And you're doing the intros, right? Like the brief intros on everybody.
Yeah, exactly.
Okay. Sweet.
So I just wanted to give you a heads up, and if Conrad, you could help us on the logistics. After, Carlos, you're done addressing your last question to me, which I think you've got 2 or 3 others after that, I might need to just go off video and take care of a couple of other things, if that's okay.
Yeah, no worries at all.
Thank you.
And we have, sorry, Conrad, we have at 50, you're cutting it, right? Like that's the.
Yeah, I'll give you guys some time, like a heads up on time in the chat. And so at like 45, I'll say, 5 minutes left, and it's not like a hard cutoff, but
okay. Awesome.
Yeah. We're just waiting for 2 more.
Yeah, I think we need
Allison and Michael, I believe.
Yes, exactly.
One thing we could do if we want to keep this on track is, maybe just get going, since Michael's here. He and I are doing the first question, and hopefully Allison can join in the meantime.
Yeah, that's not a terrible idea. 1 second. Let me see if I can quickly reach Allison.
All right, I think we got everyone.
Yeah. Looks like we have everyone. Just make sure we are streaming and up for everyone. Cool. So I think we're about ready to kick off. I'm actually very excited to introduce our next session titled Market Perspectives, How Fintech Will Navigate the Turbulence. I think we're in for a phenomenal discussion about some topics that are definitely top of mind for everyone. The discussion will be moderated by Carlos Alonso Torres, who's a principal at Fintech Collective, and we'll be joined by Allison Lange-Engel, who's a partner at Greycroft, Darna Mehta, head of America's Fintech Investment Banking at Bank of America, Margaret Lim, managing director at Amex Ventures, Jake Gibson, the founding partner of Better Tomorrow Ventures, and Michael Lamb, VP of Consumer Growth and Operations at PayPal. Thank you, and I'll hand it over to you, Carlos.
Thank you, Conrad. Perfect. Well, thank you, everybody. Well, first of all, to the speakers, of course, for making time from their busy agendas, and of course to our audience as well. I think we have a very good lineup today to discuss a topic that is not exactly light, definitely important and on everybody's mind. No, so I think if we think about the current market turbulence, and how fintech is navigating it, probably best for us to begin discussing what this turbulence is all about. Get a perspective from some of the main factors of consideration here, given the amount of things that have been unfolding in the world, and their significance in influencing what we're seeing. So maybe to kick things off, I would love to invite Darna to give us a bit of a perspective from a more macro, lens. She, of course, has a very sophisticated understanding of the banking sector. I think maybe that's a good way for us to kick off.
Thank you, Carlos, and great to be here. This is a very exciting topic because fundamentally there is a shift in how we consume financial services today. So while we're going to talk about, like you said, a lot of heavy topics and a lot of things weighing the markets down, I think to put things in perspective, a lot of people attending this conference believe sky's the limit for fintechs. And there is, I think, a temporary shift in how people think about the prospects of a successful fintech company. And there are some permanent shifts, but all said and done, I think this is a pretty unique opportunity, one that continues to gain market share in all volatile environments. So as an investment banker, what I would say is you have the opportunity to bring connectivity and proficiency to M&A discussions between buyers and sellers. You foster a fertile meeting ground between investors and capital issuers. And what happens from a macro context has, a lot of meaningful bearing on that dialogue. So if we just look at, back to your question on what's happened from a macro setting, if we just look at what COVID set off, there was this rapid adoption of digital services. On the back of that COVID phenomena, there were a lot of stimulus checks and PPP checks written out. And you saw this surge in liquidity, increase in adoption of digital services and spend, which effectively flushed the equity markets with a lot of money. And so what you saw was this environment of unique growth with a lot of fintech companies, supported further by the equity markets, and that just caused this rapid run in valuations. Now, what has happened since? Obviously, COVID led to a lot of supply disruptions, and the Ukraine war added to pressure on inflation, so the rates started increasing. And in the backdrop, what happened is a lot of companies that weren't ready to be public companies access the robust equity markets in 2020 and 2021. And so as rates rose, growth estimates slowed, the exuberance among consumers and businesses started to wane, a lot of these management teams started missing estimates. And the light started to shine away from growth at all costs. So what you are seeing now, I would say, is just to put some numbers around it, a market where valuations of these high growth B2B companies are down about 60 to 70% in the public markets. Valuations of consumer oriented companies down 75 to 95%, depending on who we're talking about. And as a result, all of that has bled into the private capital raising market. And you're seeing a real shift in where things get priced. I think some of this discipline is now here to stay. But I will tell you, in my 25-year career, investors have amnesia. And within a 5-year time frame, they forget some of the pitfalls that they had to manage through. So I'm not saying it's here to stay. I think there will definitely be a higher degree of discipline. I do view some of the things that have happened in the last month as not as meaningful in terms of the shift in the landscape as what COVID did. And if you think about the second order impact of what transpired after SVB, yes, there is going to be some impact on fintechs. I think that impact is perhaps more pronounced with some of the fintechs who serve the banking software, market. And if you think about it from the lens of a bank who is now very focused on risk management, are they going to devote the budgets to, roll out big tech projects? Unlikely. I think the second thing that's going to happen is there will be consolidation. And with fewer banks, you'll have fewer clients. So there is I would say, impact on the fintech community. I don't think that it bleeds into every subsector of fintech. And I do think a lot of the reliance by fintechs on sponsor banks does come under a lot of scrutiny eventually. I think that's probably a thing that the regulators focus on. In 12 months, they do have bigger fish to fry currently. But one has to ask whether business models like prominent issuers of debit cards, checking accounts for businesses, credit cards on the back of small community banks are going to be asked to actually become bank holding companies and really manage their businesses with the same rigor that some of the larger institutions have to. So I think there is an impact, but it's not as significant as what COVID has taught us. I think it was a very unique period in all of our careers, a lot to learn from that. But nonetheless, I think there is a lot of growth potential for fintechs that exist and a lot of new ones that will continue to be founded and grow.
Awesome. Thank you. And I think we'll unpack a lot more of that as this conversation unfolds. But maybe before we talk more about, how much some of these disruptions are short-term versus longer term, I think it would be interesting, Michael, to get a bit of your take. I think you are very close to the pulse of consumers, right, in the fintech universe, consumers of fintech, so to speak. And what does this environment actually mean for them, right? Like, let's go micro for a second and speak about how it's actually affecting them, the end users.
Yeah, super. Thank you, Carlos. And I might start by agreeing overall with Darna's appraisal. When we hear from our consumers, the discussion has really changed in the last 4 to 8 weeks. The consumer dialogue at PayPal through the pandemic, was, all about enabling new behaviors that were more prominent and more important to folks in order to cope with the broader circumstances. People were frankly quite adventurous about what tools they were willing to use, what companies they were willing to do business with. We could see this in the distribution of merchants where our consumers were shopping, became as broad in that period of time as anything we've seen, since 1999 and, startup.com. In the last 2 months, the dialogue, and in particular in the last month, the dialogue, what we're hearing from our consumer has changed very substantially. We've gone pretty firmly to, a note of concern. The flight to safety that you see in the newspaper headlines, we see in our data as well, a consolidation of folks' commercial activity with a shorter list of better known, sort of trusted institutions. We also see that in the distribution of funding instruments folks are using on PayPal. We can see the money moving to the blue chips, too big to fail, don't have to worry about it. So that is real for sure. But maybe, more promising, and I would argue more durable, what our customers have taken away from this is the need to be more attentive, to be more involved, to be more actively managing and more active in choosing which financial services providers you work with. And then, a lasting need to make your money go further. So, we may not have quite the same willingness to try anything from any new company who happens to, have a good ranking on the App Store. But even the average PayPal customer, who is by no means an adventurous, or even necessarily super sophisticated consumer of financial services, has now learned to think of these as important tools to make your money go further. And in the broader environment, folks have, lots of interest in and willingness to try those tools. So, a new, I would say, sort of emphasis on institutional familiarity, confidence, and trust. But we have a consumer base who, are intrigued by what these innovative tools can do to make their money go further, and they're not moving backwards on that.
Perfect. I think that, yeah. So, some of the things you're saying, right, such as concern, flight to safety, institutional familiarity, I think are definitely themes that will continue to transcend this conversation. But first, maybe before we look at that, so I think it's clear sort of what the current landscape is and what we're facing. I think it'd be interesting to talk a bit about what are some of the things that we think are short-term versus probably more long-term changes or themes that we will continue to see. So maybe I would love to invite Allison, who brings ample experience as both a former operator and now, of course, an investor, to give us a bit of her take on that.
Yeah, I mean, I think it's great to see everyone. As a former Wharton alum many years ago, it's great to be here. So thanks for having all of us. I think it's hard to have a crystal ball on the long term, but I think the short term bleeds into the midterm here. Like, I don't think this is months of a correction of psyche, consumer behavior, business behavior. Like, I think this is quarters, years, that I think we're thinking through here. And I think the one, thing, and I think Dharma's points are spot on. Number one, when you're thinking about building a business, I think at the end of the day, you just have to go back to building something of extraordinary value, and go back to first principles of starting a business in any sector. And I'll come to fintech nuances in a minute, but I think it has to start there. Like, what are you doing that's different? Have you identified a user pain point or a business pain point? And what are you building, that's highly differentiated? And I think there are things that are going to be out of your control. And that locus of control seems far more wild than it did 2 years ago, when we had, really unsustainable growth and behavior across the board. And so I think settling into a world where, it's just all about value. And I think there was just, in the investing world, in the operating world, expectations across the board, right, didn't reflect that. So I think the first point of pressure, which I think is here for the near to midterm, is certainly on valuations, right? And so as the public market has compressed, right, that puts significant pressure, right, certainly in the private markets. I think the growth stage companies, so companies Series C and beyond, are feeling that more. It's much harder to build a $500 million business, $1 billion business right now than it was. It's much harder to sell a company for $500 million than it was. So I just think the valuation needs to be something that I think, especially as an early stage founder, as an aspiring entrepreneur, I think you put it off to the side. I mean, you need to just build something extraordinary and want to be on that journey for 10 years, because that is the heart of like what it is to be an entrepreneur. So I think that's number one. I think number two, certainly fintech business models that involve lending, cards, debit, have, a dependency on a credit line, right, and a credit facility. And that's now significantly more expensive. So you have to think about, and I don't have a crystal ball on where interest rates are going, but I don't think they're going back to zero, right? So I think you're going to be in this range where capital across the board is more expensive. So what does that mean? And I think all of this puts more pressure on the founding business model you're going to have, and how you're going to resource your company across the board. So I think the interest rates, cost of capital is higher, certainly more, I think, in the consumer world, where there is this dependency often in a fintech, to have credit to balance. And so that's, I think, requires founders who really understand the capital structure and are really savvy about that, because I think that's a little bit of a higher hill to climb. And so can you build really differentiated products where you're not getting squeezed by, or your cost of capital doesn't become too cumbersome? And I think, the last piece is, really around regulatory and scrutiny as well. Like, I think there's been so much going on that there hasn't been as much focus here, but
it is bubbling up. And I think the sponsor bank relationship that's been, that Dharma mentioned has been such a foundational piece of growth. And I think there's going to be more scrutiny there. There's more scrutiny over the BaaS, players as a segment. How sustainable is that? A lot of companies are growing, realizing they need to own their own stack to build product faster and be compliant. So there's tension between getting to market faster and using third-party tools versus consuming more capital and building them yourselves. And I think we will continue, we'll continue to see that. But look, I think we are optimistic about the future of innovation. It's the work that we do. I just think the path to get there requires, frankly, some more intentional thought from the very early stages. And, it goes back to, building an exceptional business that has some inherent differentiated aspect to it, and especially as it relates to distribution. And that I think is where probably the highest cynicism might be around consumer fintech is building a business where you're raising a seed round or a Series A, right? And half of that money is going back into paid marketing, to a few of the biggest tech firms in the world. And so I think that model fairly is under a lot of scrutiny, right? And so can you reach consumers in a way that's really cost effective and keep them and retain them, and fulfill the needs, that Michael was talking about. So I think we're still believers in it. We are actively evaluating businesses across the entire fintech sector, but I think that is might be the highest hill to climb as it relates to investors kind of applying the most scrutiny at this point in time. But I think we're all in this business because we believe in change. It's still too hard to get access to capital. It's still, takes too long to move money, open a bank account. Like the friction hasn't been solved. And I think that's the really exciting opportunity here. But the underlying business model to solve those problems, I think, is what needs to evolve given the market pressure.
Definitely. And we'll talk much more about a lot of these metrics and the ways you can assess these businesses. But maybe before we do that, let's turn to sort of how deal making at the early stages first looks in this type of environment. No, Allison, you started talking about creating extraordinary value, and then you ended with exceptional businesses, which is, I think, what any early stage investor is always on the lookout for. So maybe, Jake, you spend your days, right, talking to very young companies. How, from a VC perspective, right? How does deal making look given sort of the higher bar and the added pressure on all these fronts that Allison was highlighting?
Yeah, so I think it's one thing that's worth highlighting, and this kind of touches on the previous conversation about short-term versus long-term, is the period that we're in right now is not the anomaly, right? Like it's not like this is a short-term blip where everything's going to be harder and then we're going to go back to some version of normal. The anomaly was like 10 years of zero interest rates and kind of a crazy bull market on the back of that, and then going parabolic in COVID, and kind of everybody getting really frenetic and thinking that like everything was going to be, or like every fintech business was going to explode, just like all the public companies were doing. And then, like Allison said, just kind of throwing cash at it to pay for customer acquisition, to prop up companies with upside down balance sheets and upside down unit economics. So all of that was the anomaly. And the period that we're in now is essentially just kind of a reversion to the mean. And so we don't really think of it as like a higher bar. I think that there were a lot of people that just didn't have a bar over the last several years. And now it's back to, as Allison was alluding to, just building real businesses. I mean, at the end of the day, if you are a startup and you're raising venture capital, your goal should be to solve a real problem for a real end user in a sufficiently large market to build real enterprise value. And I think that's something that just kind of got lost, especially in the fintech space when capital was so free and anybody could raise a bunch of money. Like if you look at a lot of the neobanks and stuff, all that is at the end of the day is a regulatory arbitrage. Like interchange is by itself is not a great business model. The lending companies and the insurance companies were really balance sheet intensive, really capital intensive, and just could not compete against the incumbents on cost of capital. And but we're able to access like really cheap capital in the venture market and take advantage of that until the market decided that wasn't sustainable anymore. So we basically just had a period here where just a lot of businesses that had no business existing in the first place were raising a lot of capital because they could, while not solving any sort of new and unique problem for any real end user. And so I think the market has kind of shifted its attention back to like, what are you really solving? What value are you really producing? And how do you get paid for it at the end of the day? If you're giving everything away for free, like how you're clearly not building anything of kind of sustainable value. And so it's more that the focus is just shifted back to, if we're going to build things in fintech, like you need to really be solving a problem. And I think it's also worth highlighting to that point that like a lot of these businesses in the US, you know, most of us in the United States are just not predominantly like underserved by the existing financial products. So like a Chime account and a Chase account aren't substantially different at the end of the day. And so when you're trying to build a business like that, or if you're like the 100th neobank, it's so much harder to build real value because your end user just doesn't really need you. You're not solving a new and unique problem. And so I think that's one of the things that people kind of need to refocus on is like, rather than just trying to take what's out there and make it a little bit more digital, a little bit more mobile, a little bit prettier, maybe try to rethink the overall business models and rethink like, what are the real problems out there that need to be solved? Like, I don't think that like having a slightly better banking app is a real problem that needs to be solved. Instead of thinking of it as like higher bar, I think it's just a refocusing on building real businesses and solving real problems.
Yeah, that makes sense. That makes sense. And Margaret, I'm curious to get your take because you know you're also investing, right? But from within an existing financial institution, right? That of course built a very real business model, no, and has done exactly all of the things that we're saying that these companies aspire to do, no. So I guess from a CVC perspective, how are you guys looking at this conversation?
Yeah, so from a CVC perspective, you know, as we think about and the conversations that we're having with startups today, I think the conversation has really kind of shifted in terms of just companies, you know, prior to this current environment, were just interested in, okay, capital deal terms, who could move the fastest. But now we're starting to see a shift in companies actually really paying attention to what each investor can bring to the table, right? How can the assets of your network, et cetera, help this particular startup or this founder with go-to-market, with developing, you know, robust, sustainable operations. And I think in this environment, I think we're starting to see companies actually look to institutions like us to play several roles. And the first is, Michael had alluded to, right? Customers are now flooding to trusted, globally recognized brands. So startups are now starting to realize that the partnership, the distribution channels that the strategic investor like an Amex brings to the table can really help to unlock that innovation and open up a customer's willingness to try a particular piece of innovation that they may not have been quite as willing to venture into if it had just been a new app in the App Store, for instance. But if it's in a trusted digital channel that they're engaging with every day, that suddenly opens up their minds because, as Michael had alluded to, people still want the innovation. They still want convenience. They still want these pain points eliminated. They just want it in a trusted environment where they know that their information is safe, their money is safe, etc. So that's piece number one. Piece number two is that we're starting to see, and I think that the theme here has been fairly consistent, is that budgets across the board are tightening. So if you're a fintech and if you're starting to think about selling to large global enterprises, how do you navigate the organization? These companies are now starting to realize that having an internal champion that can help you navigate the decision-making environment, think about making your pitch more relevant and more robust, are actually really helpful beyond the check, right? So I think that's element number two. And then the third element, and this has been, I think, touched upon by various panels on this call today already, is valuing it. A lot of startups are now starting to awaken to the idea that their processes need to be a lot more robust, which means thinking through what does an enterprise-grade compliance stack look like if you want to sell into, a major bank, right? Or what do I need to think about as I think about licensing across various regimes? And this is where they start to think through, okay, beyond the check, are my investors now able to bring me that element of expertise? And this is why I think we're starting to see an increased openness to partnering, I think, with strategics like us.
Thank you. No, I think that makes, so several good points raised there. And obviously you highlight the shifting nature, right, of the environment. I think also also the shifting mentality, right, that founders need to have to be able to build, to be able to build lasting businesses and extraordinary value, as we were saying before, given where things are. No, and as we said, this is as Jake was mentioning, right? Like a way to think about it is that the anomaly was what we experienced, not necessarily what we're experiencing now. So maybe before we continue to talk about the types of companies, let's talk a bit about the founders themselves, right? So maybe, Michael, I'll look at you for a second, because we had a very interesting chat the other day about data-driven growth, and sort of how that's impacting founder mentalities. How do you think that operators need to think in this environment more specifically, right? And what traits do you think will make them more successful?
It's a great question. And I won't pretend to speak to the founder, startup, true innovator here. I can tell you what has changed for us at PayPal, what we have learned, which is that sort of traditional metrics and ways of thinking about the customer and building the business that maybe made sense 10 years ago, are letting us down a little bit. So, hey, if you're a financial institution and you were engaging with your customer once a month, once a week, you probably were doing pretty well. And we saw this reflected in the sort of public metrics, even that we still use at PayPal. We talk about active accounts on a 12-month trailing basis. You'll see us more now finally starting to talk about monthly actives. The thing that was very clear to us through the pandemic was that monthly engagement means you're dead. Monthly engagement is not engagement. Weekly engagement is not engagement. The customers who were using PayPal more than twice a week, the customers who were using us on a daily basis, we saw their usage explode during the pandemic, and it has remained exceedingly high. Customers with whom we had a once a month or even a once a week relationship, we probably lost share with those customers. And so, for us, it's just brought home what's probably obvious perhaps to other more digitally, even more contemporary, more digitally native or startup companies, which is it's daily or bust. So we need to be engaging, adding value in conversation with our customer every day. Maybe, by the way, not facilitating a complex transaction. That doesn't mean they're using our pay later functionality or pay in full on a daily basis. You may not even be transacting in a sort of strict qualified sense on a daily basis, but we need to find ways to add value, to deliver on the value prop, to engage daily. And that has huge implications. Obviously, changes your metrics, but then it changes how we think about building the products. As a financial service, it's very easy to build tools and put them on the shelf for your customer. And great, then the customer may take them down when they need them, but that is not a recipe for daily engagement. And so we're in the middle of a very substantial transformation, really looking at each product line and thinking, hey, how do we engage and deliver value every day, even if the customer isn't necessarily transacting with this tool set?
Yeah, I guess one thing I'll add to that, it's an awesome point, Michael, is we have companies up and down the whole spectrum, and we do have some that are consumer fintechs at scale who have more of a monthly engagement model, and it works if you're at significant scale. But it is hard, no question it's harder, and it just puts pressure on your business model, right? So is that a subscription tier because you're not going to monetize it well enough on transaction? Are you putting enough in each subscription tier so you keep you keep a high retention, which is also critical to building an enduring business? So the product you build, the engagement you're expecting, right, it has to completely tie back to the business model and how you price it. And I think I was at LinkedIn for a number of years, which is, but the corollary of social and gaming and that degree of engagement, I think, is highly relevant to how you think about, building a consumer fintech. And we look for that experience, when we're evaluating and meeting consumer fintech founders. And I think it's equal parts. Do you really understand the rails of what you're building? Do you understand the industry deeply? But then do you also have kind of an X factor on product and design, right, that gets you to, a much more engaged user? Because if you can't get there, then you need to be at significant scale with some sort of pricing power to monetize what you're doing. So
those are some of our touch points too. Those same experiences you mentioned.
That's one of the hardest things in consumer finance, is that people outside of payments, people generally don't want to engage with their finances every day or every week. And so depending on the product and the business that you're building, you have to think really hard about what the engagement model is even going to be, and how you monetize it, and how you keep people interested when it's not daily engagement. Like if you're an insurance company and people are engaging with you every week, that's a problem. and if you're a lending business and people are engaging with you every week, that's a problem. And so things like that, I think it's very important to just kind of think about what's the consumer behavior, and then how are you going to make money off that, and how are you going to build something that is solving problems for them where they don't have to engage with you all the time. You can't think of it like a normal kind of tech business or like a social or a gaming sort of thing.
Yeah, you're not going to get there, but I think aspirationally, and if you can't, then it's like, what are you building? I guess the only thing I would add would be what we spend some time thinking about too is, and this goes back to like the first principles, especially as it relates to consumer. There's been so much innovation around kind of, the EW earned wage access category, accelerating, having employers in the flow of fintech with all varied degrees, insurance products, fertility products, core consumer products, benefits, et cetera. And I think it can be compelling to have a B2B2C business model, right? Because you can avoid the high CAC, but then is that really the channel through which people want to engage, right? Do they want these products with their employer? What does that look like? That can be historically really challenging. Again, it's compelling without the CAC, but I just think it's always weighing, and people fell in love quickly with all of these new business models. But I think it's like, go back to like walk in the shoes of that user, right? Would you actually engage with this product in this offer format, in this environment, in this channel? So I think those are things to really reassess again.
Yeah, I think that's very interesting, especially, you guys, of course, bring a lens from an early stage perspective, right? And how we look at these things then, right? But maybe, Darna, I would love to loop into the conversation, right? Like, is this at the end of the day a global phenomenon? And if so, right, like how are companies across the world, right, fighting for access to capital? No, at the end of the day, of course, the US, the US capital markets, is often the goal for IPOs, and right now we're not seeing a whole lot of them. So at the later stages, how is this manifesting?
Sure. By the way, really interesting discussion. I think before I answer your question, Carlos, the one thing that I want to highlight in bringing all the comments from my fellow panelists together is there's going to be a ton of convergence. These single product companies aren't going to have a sustainable business model. And the convergence is going to come from the likes of Amex's, the other card banks, big banks, some of the tech companies like you've seen Apple, Google, others really fight for the same wallet share. And how you promote that engagement is by adding more and more products, marketing those products, making sure the user experience is robust. So what that opens the door to is a lot of consolidation of companies, private companies merging with other private companies. But given valuations had been out of reach for a lot of traditional financial services companies in the last couple of years, now I think it opens the door for these fintechs to be part of much larger ecosystems to actually generate the flywheel around the products they've developed and create a sustainable business model on the back of somebody else's user base. So I think there's going to be a lot of interesting consolidation that you're going to see from an M&A perspective, not only in the US, but many other markets. And now I'll address your question more directly. If you look at what's happening in some of the emerging markets, and if you were to, take a country like India, for example, about to be 1.4 billion people, almost the largest by numbers in the world. And the innovation coming out of that country is quite interesting in two ways. Number one, you really have to solve for a viable business model in an economy that does not create the opportunity to monetize by way of interchange, by way of having businesses and consumers who are willing payers of services. And I would say, in contrast, you have the opportunity to really solve the need of a really large population. So what you are seeing is, many companies that are developing more and more products faster than you would see that development occur in the US, and finding ways for those existing user bases to engage with them more, maybe through referral fees, maybe through fees that come from, in the example of a bill-based situation, the company that is receiving the payment, finding other ways to actually monetize those large user bases. The same thing is happening in Brazil, in other parts of Asia, Mexico, I would describe as a similar story. I think the key differences there are the regulatory regimes. Now, if you were to think about the question you asked, which is, there are some really interesting, gigantic companies in the making in these other parts of the world. What is their path to accessing liquidity in the US? And I think that's a tricky question. And the reason I say that is, there are definitely a different set of expectations in the mind of a public investor now. What they're looking for from a scale and market liquidity perspective is very different. So unless you are by way of, now a more modest revenue multiple-based valuation, or maybe even EBITDA-based valuation company, market cap that's $5+ billion on a sustainable basis, or even more, with sufficient liquidity for a public investor to effectively trade in and out of your stock, the path to a listing in the US without meaningful business presence in the US is pretty tough. And I think that in most cases, you'll find companies do a dual listing, but even though there has been a lot of volatility, there are some really good success stories like Nubank. Even though it is in a segment of the market as a direct-to-consumer company that has seen, I would say, a more rapid erosion in valuation than some of the other sectors, it is still a pretty large market cap company. It has a pretty interesting, I would say, segment of the market that it's serving. It continues to broaden its impact beyond its initial, origination country, Brazil, into other markets like Mexico. There isn't exactly a close second contender who is eroding market share for them. There are some unique dynamics there that I think the investors appreciate. And so I do think that there are other such companies in other countries that will see their stories resonate with investors in the US. I just think that, rather than seeing 5, 6, 10 of those come out of a single geography in 1 year, you're going to see, a much smaller number. And the companies that do come out will be stronger with a path to I would say, more sustainable public track record.
That makes sense. I mean, of course, as any VC investor knows, right, the chances that you have, it's a game of home runs at the end of the day, right? Like the chance that a company IPOs are extremely low. And of course, in this current market, as you mentioned, right, it's only gotten harder. No? So I guess putting everything in perspective, the majority of exits at the end of the day, right, are more through M&A. So maybe you did mention Amex, so I have to turn back to Margaret. And you said that there will be significant consolidation. So Margaret, you're in a pretty privileged position, right? Because you are in fact investing out of a corporation, right, that could potentially be the beneficiary of a lot of this consolidation. No? So how do you take that lens? No, how do you think about that?
Yeah, so from our perspective, I would say that I think this is I think a lot of the panelists had alluded to, a time of I think still lots of exciting innovation. And the thing is, I think for us at Amex, we take a very customer-centric approach, right? So in terms of incorporating a lot of this innovation, we have kind of a buy, build, partner approach, depending on what makes sense. But as a general matter, we have found that partnering has enabled us to deliver new products to the market faster, allowed us to test and learn, which is why I think we are actively investing and partnering alongside a lot of these companies that we made investments in. And I think what's also interesting is that what we're seeing is, I think a lot of the conversation today has been centered around, consumer fintech. But we're actually also seeing a lot of interesting innovation happening on the B2B side, especially as you're thinking about B2B companies building all sorts of interesting software solutions that are transforming major antiquated industries like healthcare, like construction, that they then provide really interesting workflow efficiency improvements, generating that data that can then lead to a good plugging in with a fin like us. So it becomes very, very synergistic from that perspective of combining what we do best, which is financial services, and what startups do best, which is tech and innovation. So I think from that perspective, which is why we have continued to stay in the market, continue to invest, even throughout all sorts of economic conditions.
Thank you. No, that's a great perspective, and indeed, our conversation has been quite focused on the B2C. You are right. There's ample opportunities on the B2B side. arguably even more so, right? So maybe let's take it back to the early stage now. Maybe Allison, Jake, how are you? Let's look ahead now. Let's give our audience a sense of some of the interesting spaces that we're seeing and some of the things that we can be excited about in either B2B or B2C. What do you guys see as you look ahead to the next 5-10 years as some spaces where we can really create extraordinary value, as Allison put it at the beginning of our conversation?
Well, I think we're still really interested in just in this whole theme of embedded fintech and all the things that means. So the software that kind of enables financial products to be built faster, easier, cheaper, in a more compliant way, and then distribute them through various other tech platforms versus kind of going out and building these commodity financial services businesses and just spending a bunch of money on marketing. So we've been investing a lot in that. We're really interested to see how it plays out on the banking side, lending side, insurance side, payment side, you name it, and whether that gets distributed through marketplaces, vertical SaaS companies, through other fintech companies, or what have you. We have this view that if you kind of lower the barriers to building financial products and to distributing financial products, then you'll start to see a lot more innovation in those financial products. We invest globally. We think a lot of these themes around embedded fintech and new and innovative financial services are playing out globally all at the same time. So like rather than the business models that work here, like getting kind of copied in other geographies in 5 or 10 years, as was kind of traditionally the case in tech, and fintech right now, especially with mobile adoption and internet adoption, as it is throughout all the kind of emerging markets that we follow. All these themes are kind of playing out at the same time. And in many of these markets, it's actually playing out faster and much more interesting way because there's not as much legacy infrastructure and stuff. And so a lot of the things that I complained about earlier about kind of direct to consumer business models that don't really or haven't really worked here in the US, I think there's a lot more opportunity for those things in other markets where there's not as much competition and not as much legacy infrastructure. There's a much bigger kind of underbanked or unbanked population with much more significant problems to be solved. And I think there's a lot of just pure like data and software problems in financial services to be solved as well. I think there's lots of things to be done around KYC, AML, KYB, fraud prevention, especially with everything we're seeing in AI over the last couple months. I think you're going to see an explosion in various sorts of fraud, and there's going to need to be much better software in the banking world and in the fintech world to minimize the impact of that fraud and to kind of keep up with it at the end of the day. So we're looking a lot at stuff in that space as well.
If anyone has read the Hindenburg report, that's a case in point for where some of the software capabilities Jake referenced could come in handy.
Yeah, exactly.
I guess what I'll add to Jake's, totally agree. On the embedded side, I think another area for us is still that we're interested in is cross-border payments, cross-border, facilitation. There's a lot of players, but it's still not solved. We think it's a huge market. We see the same kind of as it relates to data infrastructure and have investments across KYB and fraud, but the new world of AI spins some of those models in a different way. So I think founders are increasingly needed to build for a future state than kind of even today's problems will look very different soon enough. And I guess the last piece I would add would be kind of the cross of fintech and healthcare. We talked about it a little bit already, but kind of what does fintech and healthcare look like? Those funnels, the workflows, the merchant, kind of healthcare provider into the consumer experience. And then same for climate, renewable energy, right? There's just there are major projects, development, timelines, financing, marketplaces around those verticals. And kind of people are seeing the competitive advantage of having a great payments experience, reconciliation, money movement, et cetera. And so I think fintech, we take a sector approach to what we do in terms of the structure of our firm, but we're increasingly trying to make sure all of our sector teams are threaded together. Because I think a lot of the themes transcend the industries that are growing quickly and have a ton of innovation ahead of them.
Definitely. So that's interesting. That's a very good point, right? Because I think this brings up the theme, that every company will eventually be a fintech company, right? So how do you become a fintech investor, right, in the future if, as you say, it's going to permeate more and more things, right? You talked about healthcare, you talked about climate, you talked about renewable.
Yeah, I mean, I think it's, it goes back to just thinking about what is the kind of what Jake started with, what is the really urgent need from the business or the consumer? What is the tip of the spear? An early stage product generally can solve one use case to start, and then it needs to grow from there. But I think that isn't changed. But I think the idea that innovative products are not only going to be consumed by tech first companies, right? They're going to be consumed and in demand, from industries that haven't always adopted the most innovative products or payment products, and I think that's changing, right? I think leaders of all of these verticals are well aware, right, of what's happening, and either are changing their orgs to ingest more innovative products, hiring new teams, and or making acquisitions so that they can get further up a curve, because they see the opportunity of embedded fintech. They see the opportunity of delivering a better experience across the board. And fintech is one piece of that. So I think it's just, understanding with each product, what are the different use cases, right? It's hard to have, the largest companies, do transcend industries pretty quickly. But then some start more narrow, but then can they cross into other verticals, right? There's been a ton of investment, like Margaret was talking about, as it relates to vertical software tools, workflow, and then, financial applications being part of that. We love that model as well. But I just think you just have to have kind of an agile, approach, and ideally founders who are that ambitious to think about like a cross-sector application, or each of these sectors are, multi-trillion-dollar sectors in and of themselves. So if a company is innovating to solve a lot of the problems in that stack, those can be really big and exciting businesses as well. So yeah, we just try to always cross-pollinate as much as we can and get to know everyone, and compare notes, because things can change, things are changing quickly.
Yeah, and adding on to what Allison had just said, actually, is we're actively thinking through what are some of the big data unlocks, right? Like with IoT, with improvements in satellite data, are these now opening up new opportunities, new data sets that we can now use to underwrite and create all sorts of interesting financial products? And we're seeing some really interesting activations with, insurance companies thinking about, insurtech companies thinking about new forms of protection. Well, now that you have IoT data with your cars, for example, or with satellite data, and what can you do with climate protection, with coastal home areas? So it's definitely an optimistic time for innovation, despite, I think, somewhat gloomy topics. So I think very happy to be here and very happy to be backing founders building the spaces.
Amazing. No, thank you for that. And I apologize for the background noise before. It seemed like the fire alarm was off in the building, but we are fine. But anyways, to bring us home here, I think it would be interesting to take it back to Michael very quick. We, as the voice of the consumer, so to speak. Michael, how do you think about that? What is can the fintech consumer, I think, be optimistic, going forward? And do you think that the outlook in terms of the safety, right, the simplicity of usage, et cetera, from a global perspective, are you indeed optimistic that this will continue to improve?
100%. We're seeing no signs of retrenchment in consumers' willingness to use more modern tools to get more for their money. We're seeing serious signs of institutional trust, the priority of safety. You never thought it would be so sexy to talk about the FDIC. Those things, of course, are clear and may or may not change. As Jake said earlier, that may be kind of back to the new normal of financial services, where folks have always taken very seriously the institutional seriousness, whether it's evidenced in how big the facade of the bank was, or the overall market cap of the company. But like I said earlier, our customers have cottoned on to the idea that by being savvy consumers of these tools, they can make their money go further, and that is they're not going to put that back in the bottle. So as discussed, companies that can deliver on that and deliver real, meaningful, motivating value to the consumer can still count on willingness to innovate and change behavior.
Thank you. And Jake, maybe your take on that quick, no? How do you think about that at a global perspective, right? Like you said, you guys invest globally, no? There are major regulatory nuances, right? When it comes to this, and likely, the technologies that that the regulators will be able to implement going forward, right, will get more and more sophisticated. So as you think about investing early stage globally, how do you how are you able to keep up with it as an investor?
Sure. So, I mean, we're never going to be experts in every financial regulation in every market around the world. We're not even going to be experts in every financial regulation in the US. And we're certainly not going to be able to kind of predict how regulation is going to change over time. So for us, especially since we're investing at the earliest stages, we are backing first and foremost founding teams, and building startups, and especially building companies of like lasting value, always means navigating a changing landscape. And so the way that we think about it is just that we hope we're backing the right teams who can see the lay of the land, who can understand it, who can work within it, who can build those novel solutions within that world, and then adjust as necessary as the world changes. I mean, we try to have a little bit of an understanding of how different markets are different. So if we're looking at a business in the US that we wouldn't want to invest in because of certain like regulatory dynamics or competitive dynamics or whatever, we might look at the same business in Brazil or Nigeria or something and see the nuanced differences in how the end users and how the customers or how the regulatory environment is a little bit more friendly, and be a little bit more interested. So it helps to have a little bit of an understanding of what's different about the markets, but we're never going to be experts in everything. So that's why we just hope that we're backing the best founders who can figure it out and build accordingly.
Definitely. And that won't change at the end of the day. I think I like the description of venture capital as the most human of asset classes. And you're right, it's going to take especially resilient founders and persevering founders like it always has, right, to solve these problems going forward. And I think, yeah, even as this environment shifts, as one of the speakers, right, said at the beginning, as people and investors have amnesia at the end of the day, I think that these are characteristics that transcend any time, and at times it's more, access to capital can be easier or more difficult, but the personalities and the types of founders that need to solve these problems will always remain the same in certain ways. So it's interesting. But thank you guys. I think this is all the time we had. Conrad, unless you think we have more time, I think this is a good point too.
I wish we had a lot more time. I think this is a great discussion. Thank you everyone for taking the time to, meet with us and have this spirited and insightful discussion. I think we all learned a lot and really appreciated you guys. So thanks again, and hope you guys enjoy the rest of your day and the rest of your weekend.
Thank you.
Having us.
Thank you.
Take care.
Hey, how's it going, everybody?
Hey, happy
How are
Friday.
you? Great to meet. Happy Friday.
Great to meet you as well.
Hey, how's it going? It's so nice to see everybody.
Yeah. How's the morning gone for the conference?
It's going really well. Some awesome discussions, and I believe that we are live streaming now, from what I can tell. Yeah. Hello, everybody. How's it going?
Good.
Hello.
Fantastic.
Beautiful. So I know we're waiting on a few more, but this is the long anticipated consumer fintech panel. I've been on the edge of my seat for months.
Thank you for the organization. It was seamless and very well done. So thanks for that.
It is a huge team effort, but thank you for being here today. I know that we're waiting on a few more, but when we have Ivy and Dakota, we'll get started. Just so you know, we're live streaming. So our audience is here with us as of now. it's been a really interesting discussion. Yesterday we had a in-person session too. So a lot of the topics that we'll be exploring today were touched upon. I heard a lot of interesting hypotheses. Hey, Dakota.
Hello, how's it going?
Good to see you.
Good to see you too.
And just so you know, we're live streaming.
Oh, awesome. Okay.
So I think we're waiting on one more. We'll get started soon. But I'm curious how much time we will take on the first topic alone. I feel like we could talk about it for longer than the entire panel session today.
Yeah, there's been no surprises and no big changes in the last couple of months. So I'm sure there's nothing to talk about.
Exactly.
This is one of the final panels too, right? Last couple ones of the day.
That's right. There's one more after this. Have you all had a chance to drop into any of the other ones?
Yeah, I checked in yesterday a little bit, but yeah, I guess we saved the best for last, I guess.
That's exactly it. I wasn't going to say anything, but. Hey, Ivy, welcome.
Hi, sorry for running a few minutes late here. How are you?
No problem. Good to see you. And just so you know, we're already live streaming. I'll get started in about a minute. Let everybody settle in. All right, so I've been waiting to get the band together. Just so you know, at some point, somebody's going to take a group picture of us since we haven't actually met each other in person or live yet. But I'll just go ahead and kick things off. So thank you everybody for joining us for the Consumer Fintech Solving for Tomorrow's Needs panel at the Wharton Fintech Conference. My name is Yoni Upart. I'm a first-year Wharton MBA student, and I'm really thrilled to be introducing all of our amazing panelists and moderator for today. So today we have with us Sanchi Gupta, the Director for Business Operations at Chime. We have Dasmar Singh, Product Lead at Cash App. Ivy Wang, the Director for Capital Markets at Upstart. Dakota Rice, Founder and CEO of Poolit. And our moderator for today is Connor Love. So thank you for sharing the time and the space. I'm really looking forward to our discussion today. And Connor, I'll kick it over to you.
Yeah, awesome. Hard to follow. I'll echo what was said before. I mean, obviously, really sharp on all the communication and how you guys have put together this conference has been great. But yeah, hopefully we can have a really open and honest and just kind of fun discussion today. I think we have a lot of different members of the panel who are all experts in their own regard. So I know we have a bunch of topics to get through, but really just maybe to level set us, maybe we start with just introductions from the group, and from there I can dive in and throw a couple topics and questions out. But maybe we just go down the line, and maybe Ivy, you start first, and then we kick it off with introductions to the panel, and I'll close us off with intros.
Great. Thanks so much, Connor. And yes, I really appreciate Yonit and team. It's been really great to see, and I appreciate the invitation here. My name is Ivy Wayne, Director of Capital Markets. I'm responsible for our forward flow, what we call forward flow, institutional investor relationships. Also helping to develop our funding strategy for new products. My background is in structured finance, so I've spent most of my career at Barclays and at BofA Merrill in their asset-backed securities banking group prior to Upstart, and did my MBA at Sloan, undergrad at Wellesley.
Awesome. Dakota, you want to go next, and then you can kick it to other members of the group?
Sure, that works for me. My name is Dakota. My background, I worked at Goldman for a while, then I was in private equity at Carlyle and in the hedge fund at Coatue. I left Coatue to go to HBS to focus on starting Pool It, and Pool It is a platform where we enable people to invest in top private equity, venture capital, and hedge funds, and we'll continue to expand to other strategies over time. We sort of built the building blocks of the fund admin, transfer agency, et cetera, underneath the hood. So we also sell those APIs to other fintechs that are trying to do the same thing, and to advisors. So that's some background in our business.
Awesome. Sanchi, you want to go next?
Happy to. Hi, I'm Sanchi. I am a director in strategic initiatives and business operations with Chime. Chime, if you guys just really quickly, Chime's a financial technology company. Our mission is to help members who aren't well served by large traditional banks to help achieve financial peace of mind. My role at Chime is focused on near-term and long-term strategy for Chime. And prior to Chime, I was with another fintech, which is Intuit, and worked through the acquisitions of both Credit Karma as well as our most recent acquisition with MailChimp. Prior to Intuit, I was with McKinsey in their Silicon Valley office. And prior to that, went to business school at Chicago Booth.
Awesome. Desmer, you want to finish off, and then I'll get us going?
Yeah. So I'm Desmer, product lead at Cash App. I specifically focus on families at Cash App. So over the last couple of years, made it possible for families, including teenagers, to have their own debit card, use P2P on Cash App, invest in stocks and Bitcoin, have a savings account. My background has mostly been in fintech as well, almost all of it. Started my career as an early engineer at Venmo, as an iOS engineer, went to product there, went to business school, Stanford, was at Pedal, which is like a fintech credit card startup as well. And then I spent a couple of years at Uber, and now I'm here, excited to be here.
Awesome. I guess I'll finish off with the intros and then kind of tee us up with the first couple questions. As Yona mentioned, I'm an early stage partner at Lightspeed, spend the majority of my time in all things fintech. So, for us, that means everything from lending, credit, banking, payments, infrastructure, you name it. Oddly enough, like many of the group, I also went to business school, went to the Wharton of the West in GSB, like Dasmer here. Really weird kind of background before that, spent about 6.5 years in the military, have a data science background, and fell in love with fintech in 2016, 2017, really in and around the time where Upstart started, or I guess a little bit before that, or excuse me, a little after that. But the gist is we're a global venture capital firm investing all the way from seed through growth stage investment. So happy to moderate this panel today. I think maybe a good place to start is kind of the obvious, as we alluded to at the start of this call, a lot has changed in the last not only months, but maybe a year or so. Whether high rising interest rates, changes in the macro environment. Obviously, we've all lived and are living through what's happening in kind of the banking ecosystem. Maybe just let's level set across the group. Like, what is the state of the nation in fintech right now? I mean, I'm an optimist. I'm naturally an optimist in how I live, and obviously we put our money where our mouth is there as well. But I don't know, maybe we just go down the line again and say, what is the state of the nation? How do we think about all these recent macroeconomic changes? And maybe we start in reverse order. Dasmer, or if you have anything to dive into first, maybe we start with you.
Yeah, happy to start thinking about this one. This is an interesting one. A lot's happened, and especially with the higher rates overall. I think in general, that means that because of higher rates, when you look at like the the compounding LTVs of customers overall, we see them decrease over time just because discounted cash flows become less valuable at present value. And what that means is probably lower, especially in fintechs, like consumer fintechs, lower bounties to open up a new savings account, probably lower referral bounties. Like there's just a decreased budget for customer acquisition overall, just given this decreased LTV. Also, in a more bearish market, we might see fewer investing players and perhaps more fintechs that are focused on like budgeting or savings or something like that. At Cash App in particular, just a couple of months ago, we launched our savings feature, and it's been one of our strongest growing products yet so far. What else? I guess especially recently with the like FDIC, like with the recent events with SVB, et cetera, I think what we're seeing is especially these like newer banks or regional banks overall, like trying to show that they are safe in particular. We saw FDIC insurance like limits increase significantly among a few of them. I think like Betterment's at like $2 million and Wealthfront's at like $3 million. SoFi's at $2 million as well. So it's above the standard $250K, and they've been able to partner with multiple banks and deposit your money in intelligent ways to increase the total insurance you're getting. And similarly, also like just in order to differentiate themselves from these like the larger banks that probably saw an increased inflows during this time of I guess like whatever happened with SBV recently, it's important that they invest in also just kind of differentiating themselves from these larger banks. So like we've seen, obviously with interest rates, like yields were already rising in savings accounts, but high yield savings rates have increased even more, where like at Wealthfront you can get something like 4.3%. And I think that like overall, like these consumer fintechs that are providing ways to save in particular probably want to focus more on communicating safety, whether it's FDIC insurance, and communicate the differentiation, whether it's like interest rates.
Yeah, I'm curious, Sanchi, from the neobanking perspective and the Chime perspective. My guess is you have a lot to say here as well.
Yeah, no, I think +1 to everything Dasmar just said. I do think the importance of trust is paramount in the wake of the fallout from Silicon Valley Bank. So especially I think trust with mid-sized banks is probably more important. And yes, I do envision that customers will likely keep their deposits now in multiple places versus just one institution. And we have seen flight of deposits go back to the larger banks that hold the majority of the deposits overall. So yes, I do think both importance of trust for mid-sized banks is important. And then also I think it opens up an era where consumers are likely going to hold deposits in multiple banks. So both of those are true. We've also seen leaps in AI more recently. And I also wonder and I know, Connor, you're looking at the positive side of this, but there's also this dark side where generative AI has the potential to drive fraud. Think of what are today just poorly written phishing emails to now, graduating to very personalized, very persuasive emails. So there is a potential for fraud to also increase, and all the banks and fintechs have to be prepared for that.
Yeah, I think the fraud piece is often gets overlooked until the hits the fan, and you have to really clean up for it. So I think that's a good point to call out. Ivy, I'm curious on from Upstart's perspective, and I know a lot of your customers are a lot of these credit unions, or obviously folks focused on lending. What's the impact for you?
Yeah, sure. So happy to talk about that. So at Upstart, so our mission is to enable effortless credit to any individual, and really what that means is looking at people beyond just their credit score. And so we have more than 1,500 variables, as well as now at this point 45 million repayment history, given our I guess now we're coming up to 11 years in terms of our company history. And so that's what drives our AI model. Our business model is a little bit different than many other fintech players that we do get comps against. We are a balance sheet like company, and so we truly believe that banks are here to stay. And so we do partner with the banks that use our technology, but we also work with, in order to really serve serve the full credit spectrum as well as to move quickly. We also partner with the capital markets world, and that's where I really sit. And so, we have, I think at this point, many banks. So in terms of diversification, I think that's been key for us. But on the capital market side, we have what's called originating banks who don't hold the loans onto their balance sheet, but we essentially work with them. We are the underwriter, they are the originator, and then those loans then get passed to our what we call forward flow buyers, who essentially buy the loans and earn the yields on that, right? And so what's happened with interest rates going up by 25x pretty much within a span of 12 to 18 months, as well as I think the unprecedented amount of stimulus, both coming and then going away very, very rapidly, that's fundamentally changed the borrower behavior, especially in the quick set, the borrower that we've served, right? And so we've served at this. So essentially what that boils down to is the borrowers who typically don't get a rate from, we're pretty much at Upstart the best rate by many margins, or we're the only rate for the borrowers that we serve. And so what we've seen is not just, so we've seen basically a fundamental shift in consumer behavior, and that's driven a lot of underperformance in the loans that were impacted in 21, 22. So, and we've also then now have to deal with rising financing costs. So a lot of headwinds that we've experienced within a very short period of time. And so what that's caused us to do is just really get better at our business model in terms of continuing to diversify, not just thinking about, not just relying on what we've done so far, but really thinking about creative ways to structure and really working and continuing to work with different partners. And ultimately, our ML underwriting model continues to stay very resilient. What it's really, really good at is relative risk order ranking. So everyone in this room is able to continue much better so than any other FICO score model or traditional model out there in order to risk rank borrowers. What we've done in the past 18 months and what we've introduced publicly is what's called the Upstart Macro Index, where we're able to then distill what is the macro impact versus what is really the borrower underwriting per our model, and then recalibrate our models according to the macro environment. So that's a little bit of what we've been dealing with here at Upstart.
Yeah, it sounds a lot like some themes that I'm pulling together across all the different responses is, obviously, macroeconomic conditions have led to a, change in diversity of risk. And not only, that means from a banking perspective and kind of who you keep your capital with. I also think from a lending perspective as well. I mean, this flows up market to capital markets providers and actual lenders and banks, but it also affects the individual. I'm curious, Dakota, I mean, obviously working in the private market space, obviously, as a venture capital firm, we see this and feel this every day is, the public markets and the capital markets change almost overnight, whereas it takes a little bit longer to catch up to kind of private market assets. Curious in your take, how does this affect the private markets and obviously what you're doing at Pool It?
Yeah. I think what you find is that while larger institutional investors and a lot of folks who've had access for a long time are kind of marking down their portfolios, folks that are newer to being able to access these asset classes are kind of thinking about this as the best period in time to be able to do so. We kind of haven't seen, the only real change we've seen in our business is more people are funding from an IRA. So they're thinking about longer duration sort of assets to pull from, but folks are extremely excited. And when we think about our different constituents, I mean, we have folks on our platform that are individuals, obviously, and so they're super excited, but also a lot of advisors who represent a lot of these individuals. I think what we find more and more, our products are also open to ex-US investors. It's like we use a lot of registered fund structures for our fund of funds. And so we find an increasing allocations from international geographies versus in the US too. But I think it's been pretty resilient. I think people are excited to allocate to private markets. And I think when you look at what the macro kind of implies for the underlying companies in a venture portfolio, right? People are really excited about the sort of opportunities that come in with these lower price points. And on the private equity side, what we see is that folks are more concerned about whether a manager is able to generate alpha from financial engineering versus true operational improvements and enhancements. And so there's a lot more focus these days for consumers on, what is the diligence layer that you're doing to make sure that these private equity firms you're allocating to are generating alpha outside of just, they're not impacted as much by these interest rates. But I think also to some of the points hit it earlier, a lot of the focus for us, people just want to feel like they can trust us. It's not necessarily our banking partners because these funds are custodied And so by being custodied, they're not like on bank balance sheets, but communicating that right to people so they understand that, and them understanding the level of diligence that we're doing with the different firms that they're investing in so that they can feel good about where their money's placed is really top of mind.
Yeah. No, I think the piece of trust is quite important here, because I think we're going to see, and again, I don't plan to be a regulatory or even a high level banking expert, but I think the reality is we're going to see a couple of things. We're going to see continued diversification, like we talked about. We're going to see an increased probably form of regulation in one way, shape, or form. What that ends up looking like, I think, to be frank, none of us really know. And then I think you're going to see, and again, kind of circling back to the topic of this group, is I think you're going to see consumer behavior start to change. And the reality is consumers are in a tough situation right now. Obviously, we've entered into this different economic environment. Savings rates have gone down. Delinquencies for mortgages and credit, different lines of credit have gone up. I'm really curious, and I'm learning from the group, how do we build trust with the consumer in this environment? What does that mean from a product perspective? What does that mean from a brand perspective? And again, I'm obviously Pool-it as an early stage company, Chime as one that's been around for a while. Obviously, it'd be good to get a sense of how you think about that consumer relationship with your customers, specifically around building trust. And again, I don't know, Sanchi, if you want to start, and then Dakota, you want to kick off after that.
Yeah, I think part of it is just reinforcing that a lot of the deposits that are with these banks are actually FDIC insured. If you look at the typical member that comes to Chime, we're looking at members who make 0 to 100K in annual income. These are not the members that have greater than $250,000 deposits. So all of their funds are actually insured and are safe with Chime and with our partner banks. But it's that sense of confidence that's been shook in the wake of the crisis. And a lot of it is just reinforcing the safety, the security, the fact that we have their backs. So from our standpoint, I think it's more about just reassuring our members.
Yeah, and I'd say from my perspective, it really resets the playing field if you think about it. It's like, wow, a regional bank that's been around for 40 years, or any provider that's been around for 40 or 50 years, are so safe. Now it really kind of flips that on its head. And so what it enables us to do is really hammer down to consumers what the value prop is, and they kind of reset us versus folks that have been incumbents for a lot longer, of a period of time. And I would say, it's really important for folks with building that trust to just be as transparent as possible. A lot of times I think when you're building product, you have to balance kind of to the mean. You don't want to put too much information out there because it becomes too complicated. You don't want to put too little because it's I think now it just makes you, we have, we share with people investor presentations that we do with external investors as an example, so they can understand what our business model is. People basically get on calls with us or come to emails with us and get on our platform and are really just curious about well, why is this working that way or that working this way? So I think once we reveal a little bit more what's under the hood, it's more complicated. And so it can lead to longer sales cycles, basically. So people are not signing documents as quickly as they were before, but the same kind of conversion is being reached. But the way you get there is just a ton of transparency. And I think interestingly, it helps build a lot of community. People, I'll go leave a call with somebody and say, look, my email is dakota@poolit.com. So you can also just message me. And people kind of like that. So in a weird way, what we find is that it's helping us build deeper and stronger relationships with customers and a much stronger, more robust community than we would have otherwise.
Yeah, no, I think that's super powerful. I mean, everyone in this group knows the modern day consumer is not dumb. I mean, you have access to information, you do your own diligence, you understand. I mean, again, for a lot of the customers of all your companies, I mean, again, it's different levels of Sanchi, you mentioned earlier, it's maybe a bank for the underbanked or for a demographic that's maybe been overlooked. This is important. This is their livelihoods, how they pay rent, how they put food on the table. So I think that's really strong to think about. I want to shift and maybe just build on that a little bit. And trust is one component that we're seeing kind of post macroeconomic reset. Another thing that kind of build on that theme of we're going to start to see consumer behavior change. I want to talk about what we think about in terms of consumer education. What level of kind of product focus and education focus do you have to do at your companies to, again, maybe we start, Dashmer, with you, is like, you're focused on the family, like you're focused on, young individuals, young families, learning some of these really good, saving, investing, banking products. How do you educate a consumer in a fintech company, and kind of what are your learnings so far, I guess?
Yeah, it's something we're thinking a lot about. Like, there's been a lot of great things that have come out of fintechs over the last decade or few years, et cetera. Like, we've been able to democratize banking, investing, and wealth management in a way that's like transformed society. And many people that just didn't have access before now have greater access, which means upward mobility that can create generational wealth for them that would not have happened otherwise. That said, we also know that access to financial education has not yet been as democratized as access to these financial apps are. There's a lot that we can do. For example, and we've seen a lot of financial institutions create these educational hubs on their websites where customers can learn. You might even see like Duolingo types like programs inside of some apps as well that enable customers, whether it be teens or whether it be adults as well, to sort of like educate themselves. If you go on TikTok or YouTube or Instagram and like you look for like financial responsibility or financial literacy, there's just so much content there, and we're seeing customers consume it, which is really exciting. But what I'm most excited about is financial literacy being a core component of education and standard education. What I mean is like in high schools. Like when I went to high school, I learned so many different subjects, and there's some that I still use every day, but there's some that I haven't really thought about since I graduated high school. And I am a firm believer that financial literacy is something that everyone has to think about. Everyone gets a job at some point and has to think about getting a mortgage or like paying for college, and understanding how interest works. So you're not at risk of being in a predatory loan or something is like so important, or understanding the concepts of compounding interest so that you can go and actually build generational wealth for you and your family is so important. And while it's possible to do it in TikTok and YouTube and other things, it feels a little bit more like a vitamin versus a pill, which is when it's like actually something that you have to do to get an A in this class to learn this concept. We're seeing this change happen pretty fast in the US, where I think 29 states in the US are now requiring a financial literacy course to be in high schools, and 15 states are requiring students to actually take a financial literacy course before they graduate high school. I think that's transformational as these students and as adults start using their first fintech apps for investing or wealth management, et cetera. So super excited to see that.
It's funny. I mean, everyone has their own personal kind of financial educational journey. And I think where you meet the customer at what age and what setting, I think is really important. And we still need to figure out, what the appropriate, and again, a lot of this is within families or within individuals to decide. But it's funny, I remember my grandfather was a longtime bond trader in the commodities market in Chicago. And so when I was young and being born, he bought me every single birthday. I'm not kidding. I have them here still. Physical savings bonds that he would send me. You actually can't even buy these anymore. I literally just happened to be in my desk. I didn't plant this, I swear. But that was his way of educating me and my brother of like, what does this mean to hold a bond? Like, and again, he would educate us. So again, like I acknowledge that was a very lucky situation where I had with my grandfather to kind of teach me and grow me and grow through, over the years. But I think you're totally right. It's we need to see more of it. It's incredibly important, and it's unfortunate it doesn't happen more often. Maybe to pivot just to. Sorry, go ahead. Yeah, go ahead.
I think what we're actually seeing a lot of is like not only are adults teaching their kids and their families about financial literacy, we're also seeing in reverse, where teens are learning about it, whether it's in school or whether it's online, and then teaching their parents. So their parents start investing for the first time because their teens are teaching them about the importance of saving some money aside every single month for your paycheck and then putting it towards long-term wealth as well.
Yeah. No, I think that's super powerful. Maybe shifting us a little bit on the education piece, Ivy. I'm interested from a lending perspective. There's been a lot of in many down economic environments, the word predatory lending always comes out. As interest rates rise, lenders, folks need to make capital. I'm interested of like your take on how you either continue to build trust and continue to educate a consumer, as we know the increase in some of these more negative lending environments or predatory lenders are going to exist.
Yeah, sure, absolutely. So I think for us, a guiding principle is we have an APR cap. And so that makes it difficult, as you can see, like our, we care, number one, about, our borrowers and consumers and making sure we're not, or always complying with like Fair Lending Act. And we work very closely with the CFPB as well. That's incredibly important to us, especially given the AI, model that we have. That's number one. And then number two, with the and just, have a hard cut of 36% APR. We literally cannot go above that. So I think to a lot of, the conversations that you're having, I think on, especially in the lending world, it's really about how we design the product itself. And so, our personal loan, what we call our core product, has been around for a very long time. Just the user experience is, we strive to be incredibly very simple language, very transparent, very frictionless as well. And even the way that we service and collect, right? Like it has to be very humane. One thing I'm really excited about is our small dollar loan products, because there's a lot of borrowers who don't qualify for a rate because they fall right outside of that 36% APR cap. And so we have a natural we have basically zero customer acquisition cost there, but we're able to then now bring them in because we're offering them an entirely different product. And the design of this is a shorter product as well as a lower loan balance. And that's essentially entryway product for them to then ultimately graduate into our core product as well. And ultimately for us to displace payday lenders, because we really want to, provide a rate to everyone, but we wanted to provide it in a way that they're able to repay it over time. So I think, just the way that working very closely with regulators and also just how we design products is the way that we really think about protecting our borrowers and doing right by them.
Yeah, I think a lot of the both the education and the trust is built by just really a transparent product that consumers just understand. I mean, the reality is, as financial products get more complex, I would argue that's, there's innovation there. Like, again, what, Dakota is doing with Pool, like that's awesome. Like that's opening up a new market that hasn't existed. But again, it's new. So I just think being transparent from a product standpoint, and again, Dakota mentioned like sharing how you guys think about this investment, sharing how you guys think about the underwriting, like that level of transparency, I think is just so important for the consumer, whether it's, these are the usury laws in this state, and this is the APR you're paying, and this is actually what's happening, to on the private, investing side, like this is what this venture capital firm does, and this is how we underwrite them, and this is how they've done. So again, I think just a key theme here is just transparency, because, I bring it back to us again, it's like, the consumer is not dumb. The consumer is smart. You may be able to trick them one or two times, but in the end, like you're dealing with, aside from, their livelihood and their life, like their most precious asset, like a good majority of their, capital base. Maybe we're kind of just a little bit past the halfway point here. So I want to pivot us into a new topic and something that's a little bit more optimistic and something that is quite interesting. At least, we speak about it at Lightspeed internally all the time. We've seen kind of this broader push within the financial services world towards real-time payments, or towards account-to-account payments, or just bank-to-bank payments more broadly. I mean, I think this has a ton of implications, not only for the consumer, for the merchant, but also for banks and financial service providers. I'm really interested. I mean, we've seen the announcements around FedNow coming out, I think, July 1st. And, we've heard about this for a long time. And, for those who've been involved in FinTech, you kind of keep see it moving and keep seeing it talked about. It's like, all right, is it here yet? When is it coming? The reality is it's coming this summer. FedNow is coming. So I'm interested, maybe not specifically on FedNow, but I really want to talk to the group around how are you thinking at your companies about, account to account real-time payments? does that change the strategy of the product offering of what you do, or how is it fundamentally changing your business? And maybe we start with Sanchi at Chime. Maybe that's a good place to start, and then would love to hear from the Cash App perspective as well.
Yeah, so just to quickly recap, we do not charge our members any fees. So we're a no-fee bank. Our revenue model is based on interchange, which comes out of debit and credit transactions that our members use. So in sort of that world, if you think about FedNow, the first two use cases that they're launching in July is one, account-to-account transfers, and the other is bill payment. And if you look at account-to-account transfers, I think what the FedNow infrastructure will enable is, of course, immediate, faster transfers, real-time payments for all the consumers. So it's a real benefit there. How that impacts, our business model generally is we do see it's going to reduce the risks and costs that are associated with fraud and plaid that we see today, because it enables just more seamless, more direct transfers. So I think from a cost perspective, we see an upside. I think we also see, though, the risk is that there is easier outflow of funds. So it's easier to move your primary banking relationships to other banks. So yes, that is, I think you could have greater inflows, you could have greater outflows. Where that rests in balance is to be seen, but that's one that we'll watch for. I think on bill payments, that one, again, the benefit to the consumer overall is just faster bill payments. If you see the sort of little video they've posted on the FedNow website, it talks about how it's late at night, your bill's due tomorrow, and you may incur that charge and late fee, but here's FedNow and you can send that payment right away. So yes, I think, great from a perspective of consumers where you tend to be late on payments and you'll save on fees. I don't foresee, the majority of bill payments that are currently incurred on credit cards and debit cards to move over using the FedNow system. We'll see, again, I think on a near term 1 to 2 year basis, both of these are low risk from our perspective. I'd be very interested in also hearing from Dasmar on, the P2P impact. And we've seen what similar real-time payments have done in different countries around the world with, of course, very different starting points, very different incumbents. But yeah, I would love to hear from you on how you guys are envisioning and P2P.
So I will caveat this by saying that I don't work as closely on P2P, but I have a lot of thoughts and I'm very excited for FedNow and instant payments in general. Customers really care about their money being as instant as possible. We saw that, and I think a lot of Cash App's success was due just to the instant nature. It made money. It just felt magical the first time you Cash App someone and saw money immediately be in their account. That felt really exciting, and it's something that our customers really valued. I mean, 60% of Americans live paycheck to paycheck. So the ability to have money instantly is super important. And yeah, just how you mentioned that FedNow video talking about that late payment that would have been late had you used normal bill pay or ACH or whatever else. But now because of FedNow, it's 11 p.m. on April 1st and rent is due on the 1st. You're able to pay without any late fees or any penalties. That's huge, and I'm excited to see that happen. This not only affects consumers, but also affects businesses, particularly small businesses that have don't have that much working capital and need money to move fast for them. And real-time payments can mean the difference between running a successful, thriving business or not having a business at all. So I think that's really important and just makes money more efficient. It also enables new things that, for example, we've also most of us get paid once every 2 weeks or twice a month or something like that. And we've always been living in the society of batched payments. ACH by definition is batched payments. There's companies like Earnin that are enabling and get paid hour by hour, but this really makes that happen at scale, where any sort of payment that has been batched before can be instant and can happen on more regular cadences, which again is better for consumers and better for society overall. But it also opens up some pretty interesting questions. FedNow payments are, from what I understand, just like paper money cash, which means that they're irreversible. Which is very different than ACH and other types of payments, and they're irreversible and final from the moment that you hit send. So how will it'll be interesting to see how banks and other financial institutions support misdirected payments. Consumers do make mistakes. We see it all the time. what if you pay the wrong person rent? That could be a really serious hit to your to your month's finances or to your year's finances. And making sure that the appropriate safeguards are in place is really important, particularly because consumers have now become used to money being sort of reversible, or you can always get a refund. And that's actually like one of the securities you get from not using paper money. And now that like this sort of becomes just like paper money all over again, it'll be really interesting. Also, it'll be really interesting to see like how do traditional financial institutions how do they show P2P in their apps? Will their user experiences become as simple as maybe the more modern fintechs? I don't know, just overall, really the introduction.
There's so much to dig in here. And I wish we had more time. I mean, maybe a couple key call outs. And again, I'll open this kind of broad question to the group. But I think you're totally right, which is the incentives to the individual, the merchant, even from a peer-to-peer payment to a personal to to business payment is vastly different for the individual. Meaning, I think your learnings from Cash App are right, which is, people, when you make a transaction, you want the capital now. And in some cases, like it's a necessity, like your small business will go under, you won't be able to make rent, like, something will insanely disrupt your life. The reality is though, certain levels of merchants and certain sizes of business actually really like the protections provided by, say, credit card payments. You have this amazing or bad thing, however you want to phrase it, this thing called chargebacks, where there's a reason why even on the ACH front, why it takes so long is because you have this dispute and this understanding process where a mistyped or even in one case like just an omission error, on the other case like full out fraud or even money laundering and getting into some nefarious action. So with time, the more instant you get, the less protections you get around whether it's fraud or risk or anything like that. So it's just interesting to me like how we always see this dichotomy between speed, safety, fraud, and protection. And kind of who it benefits that is vastly different: the consumer, the merchant, the size of the business, et cetera. So it's just it will be weird to see what the play out is. So I guess my question is like who is the decision maker here? Meaning, when we look at real-time payments in FedNow, if a consumer demands it, does it mean that merchants will follow? And because a merchant wants to do it, does it mean banks will follow? I mean, another odd case here is like, FedNow is optional. You are not like other states we talked about in Brazil, even in India with UPI. I mean, in Brazil, literally almost overnight, every bank was directly integrated to the federal bank, and you could, pay via Pix instantly as a business or as a consumer. So I'm just interested. Open question to the group: like, who is actually the power broker here? Like, who moves this market? The consumer, the merchant, the bank?
The fact that, banks are allowed to be in a receiver status, that is, they're open to receiving, but they don't have to enable push, that just then to me signals that a lot of this will eventually depend on whether the large banks end up adopting it or not. And if they do end up adopting it, what is the sort of pace of adoption? Just like historically, if you see, it's not easy to convert systems. It took us about 6 years to convert systems to electronic check processing. And FedNow has been around for a long time, but we've only now really put steam behind it and we started test. So I think those are the two big questions for me: is as long as we sort of don't mandate it and it's optional, will the large banks adopt or not? And if they do adopt, what is sort of that pace of adoption, which historically hasn't been the fastest?
And I think it's also quite interesting where, especially in the context of the United States, we are privileged where we actually do have a lot of payment options, whether credit card, debit, peer-to-peer stuff with Cash App. And if you look geographically, in those other examples, Brazil and India, it was more of a cash-based economy. So in reality, when we saw UPI and Pix, you're eating away on cash. In the United States, credit card penetration is so high that the question becomes is like, are you going to replace that? And I kind of agree with you, Sanchi, that I'm not sure we're going to see the same pull from a credit card toward, utilizing FedNow.
Yeah, two other data points to consider. I think the top 5 banks have 80%, 85% of the deposits. So there's much larger concentration, which we didn't see in some of the other international examples. And then, the RTP system has been around. Of course, it's at a cost that's greater and the adoption isn't as wide as we envision will happen with FedNow. But only 1% of transactions are actually on the RTP system now. So I think it has been around. Back to what you were saying earlier, is we're also a very different economy where we have deeply entrenched credit card usage and credit card players. And so we'll see how the experience of the US is different from the international experience more broadly.
I think at a minimum, and this is just when we were having these discussions at Lightspeed the other day, is at a minimum, you're going to need to present some value proposition to the consumer, because you're right. If banks do adopt this, if merchants say, hey, this is cheaper and I'm willing to forego kind of the protection in and around chargebacks or whatever that I get elsewhere, the insurance protection, then the consumer just got to push this. So if the consumer pushes this, is it rewards? Is it cheaper? Is there some type of affinity group that can kind of, be built around this? We'll see. I mean, that's the beauty of it. It's going to play out real time, and there's going to be a lot of fintechs building here. Obviously, traditional banks and at scale fintechs will have a say in this. So, any final words on this before we go to the last topic?
We'll just also have to reduce friction in how we transfer it. Sorry, I'm just like passionate about this. So like today, what has happened globally I'll take India's case. If you want to transfer money from, Sanchi wants to transfer money to Connor, I need your phone number at upi.com. The money is gone instantly. The first version of FedNow there isn't a centralized alias. There isn't a directory. If Sanchi has to transfer money to Connor, I have to ask you for your bank account and your routing number. I input that, and then the money is transferred instantly. So there's friction in that process. I assume we will move away from that in the future. But just talking about adoption, I think we'll see how we adopt if we continue to have this receiver status, the friction, no sort of benefits or value propositions in the near term.
Yeah, we'll see. Like I said, it will play out in front of our eyes. So I guess, looking at time, maybe just one more topic that I think is super interesting from a consumer fintech perspective. Again, backdrop in the, kind of environmental macroeconomic change we've had, the investing both from a, wealth management perspective and just a, broader equities environment has changed a lot. And we were talking about education, before. We were talking about trust before. I'm really interested right now in let's call it a non-GameStop, super hot up and to the right kind of environment. What do we think, across the panel here? How should you approach consumers in and around investing or wealth management right now? And maybe Dasmir and Dakota, it'd be great to kind of hear how you're thinking from a wealth creation and an investing perspective.
Yeah, it's an interesting one. I feel like I sort of mentioned this before as well, where especially in this world in which you're not so focused on building, like in this environment where maybe the focus is not so much on building new apps that sort of like that do sort of like enable you to sort of surge up GameStop, et cetera. I do think that the ability to help customers prepare for recessionary times is also important, or just prepare to like have that safety net is important. So whether that means like allocating multiple savings accounts for rainy days, or whether that means like having some sort of allocation for long-term wealth growth as well, which is perhaps safer than picking stocks as well, is probably the path to go. But I'm also excited to hear from the rest of the group.
Yeah, I can go. I think people are increasingly just looking for places where they can have more durable long-term wealth creation versus just sort of instantaneous. It's funny in so many ways, like we started pulling sort of the things like FTX and SEV, like we launched the product right into that. So I've only been selling in that sort of environment. So it's kind of funny to have like a counterfactual to kind of compare to. But from what I've seen so far, people are really excited about this in a way that I don't know if everything was up and to the right. Like you kind of mentioned, you could plow your money into some random ETF and it was just going to go up and to the right, that, they still would be. I think increasingly though, what this does, it makes consumers a lot they're already smart, like you mentioned, Connor, but I think they're going deep into the weeds. People will read like deeply into our PPMs in ways that like I don't think they would have like a year ago. You know, people want to understand the diligence level to very granularly. Like we, for example, we partner with a diligence partner who goes and does on-sites. Okay, we have to go beyond that. What do they do at that on-site? You know, how are you making sure that over 10 years these key people at these firms are going to continue to be around? So I think the level of investor confidence kind of increases with seeing all these underlying pieces, but they really want to know every single piece. And so I think that's really important. And I think, I think increasingly people will be focused on that. And what we also find is that as we sell out because we also sell the underlying infrastructure to a bunch of other platforms that are out in the ecosystem, folks are just looking to expand their product suite beyond just stock trading or just crypto trading or whatever. So it's really, I think in this environment, it created this really interesting market for us where people started approaching us and saying, hey, look, we offer stocks today. Could you just enable us to offer alternatives? And so I think increasingly fintech platforms that do investing will have to think about how to diversify their offerings, and it's complicated to do. And so that's a great benefit to folks like us.
Yeah, it's interesting. I mean, my take just from the venture capital approach of seeing many of these companies with different approaches is I think, again, going back to a theme we've talked about many times in a different setting, but diversification becomes more important now. Creating sound educational consumers is also really important. So knowing what you're investing, how you're investing, and then I think from just a pure understanding of how some of these fintechs are built is the business model needs to change. And again, like going back to like what we were talking about earlier, I think, Dasmer, you mentioned this is, it's not just about stock picking right now. And again, like there was this really interesting, whether, we talked about GameStop or some of the live trading that happens, like personal wealth and investing almost turned into like a sport. And that's interesting. I mean, that's a psychological like PhD project to be done by someone far smarter than me. But I think the gist is like, during that time, people got really excited about the sport of investing. And in reality, especially in this environment, I think businesses, fintechs need to be built in a way where, the incentive to driving, enterprise value to you also drives enterprise value to your customer, because in the end, like those two things are going to mirror up in one way, shape, or form. So I agree 100% that business models are important. Educating the consumer is important. Any final words on the investment piece? I know we're almost running out of time, but Sanchi or Ivy or anyone else in kind of just the investing macro environment before we bring this to a close.
I guess I'll just say I completely agree with you. I think like for me, when I started building Pool it kind of came in a time during like seeing COVID. I was working at Cotu. So I was being super diligent about like, let's look at their balance sheets. Let's see if this company will go bankrupt before we put money into it. Let's figure all these things out. Let's talk to the management team. And it just felt so unfair to me that regular individual people cared a lot more about investing than ever. And I felt like maybe that was here to stay, but like didn't have the same diligence capabilities, didn't really know what to do. Sure, all these public company 10Ks and Qs are available, but people don't understand how to do it. So I think it's a really fun time for us. I don't know. I'm sure other folks would agree too. It's like a fun time to build in because you can really increase investor outcomes over the long term if you kind of equip them with the tools to be able to like navigate these sort of landscapes. And I hope it's something that's like permanently ingrained in their mind so that as the next cycle comes out, that's a bull cycle, people are still as diligent as they are today.
No, I love that. I mean, maybe that's an awesome place to kind of wrap up. I think we should end in optimism. I think if you're not thinking about what's happening in the macro environment now, you're wrong. But with that being said, from account-to-account payments, from real-time payments to obviously imaging new ways to educate and build trust with customers, I think it's still a really interesting time to build in consumer fintech. So thanks again to the group for joining us. I think I speak on behalf of all of us where we're more than welcome to have conversations offline, online, reach out to us in our respective kind of positions. But thanks again for your time today to the group, and I'll turn it back over to Yoni to close us off.
Wow, Connor, that was just like military precision on the timing. I'm really sad to bring us to a close. I feel like we could continue talking about this forever. I love the note on bringing diligence to the consumer level specifically and about being more long-term minded. And I hope that we can keep the conversation going. We can keep in touch offline. It's really been a pleasure, and wishing you all a great rest of your day. Thank you.
Thank you.
Thanks. Take care. Bye, everybody.
Bye.